Closer to the start of European equity trading then. The futures picture, we're without that read across from the US from yesterday, but we certainly have some negativity coming through from Asia overnight. In terms of the US equity markets, well, futures are pointing lower, I can tell you that much. We've got in here the US 10-year yield, worth keeping an eye on that as bond markets back trading today. So we have that bond market trading happening in Tokyo and then here into London. So we focus in on that. The big picture, though, really is around China. We've seen weakness in some of those equity markets over in the Asia region as a result of that China weakness in that indicator. But we've also seen weakness in some FX markets that are linked to the Chinese story. Tom, what do you see in futures?
Futures, DAX futures are pointing pretty sharply lower, down 0.6%, a drop of 105 points. FTSE 100 futures also pointing lower by about 30 points, down 0.4%, and back below that 7,500 level. CAC 40, those levels as well, down by 44 points over in France. It'd be interesting, I think, to watch the luxury space, given that services component out of China. And we continue, of course, to look at the yield curve in the US. Those are trading again, of course, coming back from that Independence Day holiday, Anna, as we lead up to those FOMC minutes, Anna. Okay, so the minutes certainly one of the focuses of the markets later on today. We get lots of PMI data out from Europe as well. This is the start of the European trading day. Then the FTSE 100 down 0.3%, the Spanish IBEX down 0.5%. The Australian dollar a little bit weaker. The read across from China perhaps evident there. The dollar index a little bit firmer, just jumping around this morning. The pound and the euro fairly flat this morning. Interesting to see on the sovereign bond side of things, a different read from the Asia session. When we looked at the sovereign bond column earlier on, and it was dominated by Asian markets, we were seeing some buying there and some yields coming down. Today, we see a continuation in the sort of developed market story that we've seen of late, with yields going higher, and that continues to be the case, certainly on the UK 30-year gilt and the Spanish 2-year, the US 30-year, the Swiss 5-year as well. Interesting to see, well, maybe we disregard WTI. Looks as if it's jumping, but of course it's playing catch-up with Brent crude. Brent crude is down by 0.5% from yesterday, and we continue to watch how the market is kind of shrugging off that latest announcement from Russia that it would stay in step with its Saudi partners in pulling back production when it comes to OPEC+. Tom, what do you see on the sectors picture? That's a bit of a miserable midweek picture across these sectors. Every major sector that we're looking at in the red at this point in the session. It was real estate that led the gains, plus 2%, by the way, yesterday in terms of the sector breakdown. Today, technology is down a full 1%, plus 1%. Basic resources also taking a hit, and you can probably tie that to the China story, down a full percentage point as well. Anna, you were talking about Brent, softer as we look at that in OPEC symposium. Energy as a sector down 0.3%. You're also seeing selling in banks, financial services and industrials. Every single sector we're looking at down, but really the big losses coming through for basic resources and technology, Anna. Okay, we just have some breaking lines coming through from the FCA, regulator here in the UK, saying that it is probing if Crispin Odey is fit and proper. This, of course, comes hot on the heels of reporting by various news outlets in the UK around his conduct and the fact that many within the financial services sector have pulled away from dealing with him. He stepped away from the organisation, his responsibilities handed to others over at Odey Asset Management. So we'll watch the future of that business. And in fact, we'll be talking to the FCA a little bit later on this programme about a range of developments within the market. Let's get to the market moves, though, of this morning and what's happening here. Christine Aquino joins us from the Markets Today blog. Christine, your thoughts as we open up negative then, as expected, on European equity markets. We were expecting this negativity to come through, but the focus for the rest of the day is going to be on some of the data. This hour, we have a lot of data breaking on PMIs, services PMIs for Europe.
Absolutely, Anna. And I think really, as you mentioned, the focus going to be all about sentiment, right? This is kind of a reading on how businesses are feeling in terms of the future outlook in the region. And we have seen a relatively resilient first half for a lot of businesses, perhaps surprisingly so, because at the start of the year, a lot of us were expecting the economic downturn to come through. Hasn't come to fruition just yet, but perhaps the second half is going to be a little bit more challenging. So it'll be interesting to see their views, particularly on inflation and whether that's really starting to take a toll, particularly on their ability to pass on costs to customers.
Christine, is Greece now the bright spot across the Eurozone? They're looking to pay down some of those bailout loans earlier than expected. The Prime Minister speaking to Francine.
Yeah, Tom, I mean, Greece has actually been the bright spot even before we got Mitsotakis' victory in the election. And so it's not really quite a surprise in that sense. But, you know, overall, it has been quite the market this year. It's outperformed a lot of its European peers. And again, a lot of momentum going into this year, particularly expectations around whether it's going to be able to regain that investment grade rating that, of course, is the goal by the current government. And so I think investors still very much seeing it as a positive story. It really is just going to boil down to how quickly they can get there and whether that's something doable this year.
Yes, and as he points out, the yield on Greek 10-year, for example, already below some of the other European. I look at the Greek 10-year, for example, the yield is 3.76%. The yield on the 10-year UK gilt, 4.43. I mean, there's different inflation expectations, I'm sure, built in there amongst other factors. So that's something he's looking at. What about what's going on with oil markets then, Christine? We have Manus Cranny on the ground there over in Vienna, and we've got some sort of seemingly divergent performance in WTI and Brent, but, you know, WTI just sort of catching up with Brent from yesterday. 75 or so is where we trade on Brent this morning.
Absolutely, Anna. I mean, again, this is something that we're watching, and it's interesting that this is the second time now that we've seen unilateral decisions by OPEC countries to cut that production. And initially, there was that positive boost to the Brent price, but ultimately it proved short-lived, and we're seeing that again. And it's quite interesting timing as well, seeing as we are heading into that OPEC Plus meeting. I mean, you know, I think investors are kind of doubting really the impact of such unilateral moves, and they're probably preferring to wait and see until we get kind of a group read on the situation from OPEC Plus. Be interesting to see as well their take on demand for the second half of this year. It seems like that is quite a defensive strategy by both Saudi Arabia and Russia to cut that output. So we'll see if that's the case for the rest of the OPEC as well.
Okay, Christina Aquino, thank you very much indeed. Of course, from our Markets Today blog, thank you. You can get more from the team on the front page of the Bloomberg UK website or by typing TLive Go on the terminal. Do check out the website, certainly. Let's get a check on the market pulse then, the individual stocks on the move. Joe Easton, you'd flagged to us before the open some eyewear companies, an eyewear company, Casino, of course, over in France, and an insulation maker. How are some of those calls playing out for you?
That's right, Tom. Well, we're actually still waiting for Casino to open. We have been told by the French Stock Exchange that it will continue trading today. It was suspended yesterday after a big jump. Meanwhile, EssilorLuxottica, as you say, eye care, this is the best performing stock in Paris today, up around 2% in early trading, waiting for a price on AO World as well. That one looks pretty positive. Jefferies today saying that this company, electronics retail, almost as strong as during the peak of the pandemic. Quite surprising commentary given the cost of living crisis, but big ticket items seem to be holding up. Now, the worst performing stock on the Stock 600 is Backer Frost. Now, this one dropping 4%. This is a salmon farming company. It's actually hitting a bunch of those peers. Sales weaker than expected at the moment. And I think we're also going to review some of the building suppliers. I mentioned earlier that profit warning from SIG. That one is among the worst performers in the UK, down 8%. Also hitting Travis Perkins, Wix and Kingfisher, which owns B&Q. All these firms seeing a downturn in demand, partly due to weakness in the UK housing market as interest rates squeeze potential buyers. The building supply market really weak in London today.
Joe, thank you very much for that. Joe Easton from our equities team with the latest on some of those market moves this morning. Let's take a look at some of the things that markets are going to be watching out for today. The OPEC International Seminar in Vienna, it's underway, gets underway today. We've been talking about that through the programme and throughout this morning. In fact, a lot of it this hour. We will also be getting PMIs from across Europe, including preliminary readings from Italy and Spain. The ECB publishes its Consumer Expectations Survey at 9 a.m. UK time. Half an hour later, we will get UK services and composite PMIs for the month of June. June. Those are final readings, and at 7 p.m. at UK time, the FOMC will publish minutes from its meeting last month. And that's going to be crucial, isn't it, Tom, in terms of the market's understanding of why the Fed gave this message of pause, but hike more later.
And you pointed out, look, the dot plots have been revised higher to 5.6%. So how do they clarify that communication? Is there a need to clarify that communication? And of course, this is on the same week that we're getting the non-farm payrolls, which arguably could be important in terms of shaping those expectations. 225,000 is the survey. So yes, we'll be delving into those. No doubt the team will be in the US doing a deep dive on those FOMC minutes as they come back from their Independence Day holiday.
And we have 4 different countries reporting PMIs this hour. So we're certainly deep dive on the services side of the Eurozone economy, which, as you pointed out, crucial to inflation and that story.
Yeah, we've got Spain, Italy and Germany at the end of the hour as well. Just briefly touching in on what's going on in terms of the currencies, because euro dollar is currently at 108, just a gain of 0.1%. Coming up, we are going to dig deeper into the markets with Invesco Asset Management's Ben Gutteridge. He's relatively optimistic. He's sticking with his overweight call on US equities. How does he justify that in a slower growth, higher rate environment? More calls from Ben after the break. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Markets Today. We are 12 minutes into the European trading day this Wednesday morning, and this is the picture across European equity markets right now. Euro Stoxx 600, in fact, down by 0.3%. The FTSE down by 0.2%. The CAC and the DAX both on par with the broader index. With us in studio this morning, Ben Gutteridge, Director of Model Portfolio Services at Invesco Asset Management, regular on the programme. Nice to have you with us, Ben. Thanks for coming in. So let's start with the sort of China vibes, because that once again seems to be weighing on sentiment going into the European session. How are you assessing what comes out of China? Do you sense any bottom to the negative wave of data that we've been getting?
Well, I mean, look, I think it sort of compounds this narrative of the reopening thesis sort of underwhelming, really. And But that's not such a bad news story for the global economic climate on policy, because it's not sort of an inflationary impulse. And of course, that's sort of the last thing that the sort of global economy needs at the moment, certainly developed markets and central bank policymakers. So it's not such a troubling story for me. Of course, it doesn't sort of engender you to want to sort of get long Chinese equities at the moment. But with China weakness, with Chinese data disappointing, we've got to be alert to a policy response. And wouldn't expect anything of scale, but the weaker the data gets, the more alert you've got to be to, as I said, to that response.
Ben, when you talk about being alert to that policy response, do you want to start taking some modest positions in A shares, H shares, or indeed European companies that have that exposure? Is that how you start to prepare for that potential policy response, or do you need to see it first before you act?
Well, we're sort of seeing it, and we're not acting on it yet. So I think we would need to see murmurings of a policy response of greater scale. Now, I know you're likely going to miss some of the recovery there, aren't you? But at the moment, we just don't see enough impetus for the Chinese policymakers to deliver that irrigation-type stimulus. The growth picture isn't so desperate, the noises and the actions so far suggest something of a more piecemeal, measured approach. So no doubt we'll be caught off guard if that irrigation-style stimulus does come, but we just don't feel compelled. We don't believe the evidence is sufficient that it's imminent.
Okay, all right. So we watch to see if we get anything there. In terms of your broader, or let's go to developed markets and your broad assessment there of the risks. Previously, when we were talking to you, you said that recession was maybe upon us, but now you're sort of suggesting that recession is less likely this year. Is that just recession delayed, or is it actually a reduced expectation of recession overall?
Well, I can't believe you scanned through my previous comments. This is all so worrying now. I have to be much more careful what I say. But no, I think we've always sort of been alert to the recessionary risks, but have maintained a marginally positive bias towards equities. Look, I think we're just alert to the threat of ever tighter and more persistent constraining monetary policy. And, a recession can be sort of delayed, if you like, through resilient growth, but I don't think it can ultimately be denied. Policy is very restrictive. It acts with variable lags, and it's probably surprised many how long that lag has been. But I think recessionary risks are pretty material for next year. But in response to that, I don't think there's necessarily the right approach is to get overtly defensive at this moment. But I think recessionary risks are pretty eminent for 24.
Well, you're not getting overly defensive, and you've been consistent in terms of your overweight call on US equities. I mean, that's partly explained by your views on recession. But I just wonder how you kind of justify that in what is otherwise and still a slowing growth, higher rate environment.
Well, sort of justify it with a bit of nervousness and less conviction, because it has been quite a rewarding trade, and you start to think about taking some chips off the table. That would seem
are you taking some chips off the table?
Well, not at this moment, but certainly thinking about it.
What would be the catalyst then to take the chips off the table on that US trade?
Well, I guess more euphoria in the sort of tech space. I think at the moment we're seeing a bit of a broadening out. I think things like the Fed minutes today, if the Fed policy comes out, and as we would expect, like this commitment to thwarting the menace of inflation, the markets could be a little bit unsettled. But I don't think on a relative basis that's going to be necessarily such bad news for US equities, because it raises growth concerns. So I think it would be valuations running even hotter that would alert us or raise the prospect of taking chips off the table, rather than any concerns about a downturn, because in that sort of downturn you sort of think US equities might enjoy some relative strength.
Other global stocks of interest, we talked about Japanese stocks, and I mean they had an incredible start to this year. We talked about that with Fabiana Fedeli earlier on in the programme. Chinese equities we've dealt with. What's the sort of global stocks view?
Well, I guess it does. There is an overweight to US, so there is less enthusiasm for the rest of the international market. I think, with our sort of cautious view on China, you'd think things like Japan, with the relations they have there, would continue to be a bit disappointing. I mean, well, we would expect the economic data to disappoint. The market has been strong, but maybe that's on the back of like corporate governance hopes of improvements. We think that's sort of a narrative that has perpetually sort of disappointed and could do so again. You know, there's definitely cheapness in Europe and the UK, but look, I mean, there are pockets of interest, and of course we should remain diversified, but I would anchor to that more greater confidence on US equities relative to other markets, I'm afraid.
Ben, on bonds, we were speaking to Mark Dowding of Buble Asset Management yesterday, and he says he thinks the next big theme for US Treasuries is yields lower. Where would you want to be positioned on curve if you want to be positioned at all?
Well, I would be longer at the moment on the basis that we believe the inflationary numbers can continue to moderate in the US. Doesn't feel like anything imminent domestically, but in the US, you know, you strip out some of the more volatile elements, and I know there's danger in stripping out things in inflation calculations, but it does look as though inflation could move pretty close to target as we move through the back end of the year, and that would be supportive for the long end. We don't think the Fed is about to sort of move overtly dovish, so it would be long end, and then as the recessionary signals start to build through next year, then you would sort of go short, and that's when you expect that sort of bull steepener, the short end to move lower. So at the moment, longer dated bonds, but we'll be looking to bring that duration shorter into 2024.
And the view on gilts?
Well, I think, look, there is a lot of noise and a lot of uncertainty around that trade. Certainly, like a dovish pivot from the Bank of England, like, just seems a long way away. But you know, markets will be alert again to the prospect for policy to bite pretty hard on the UK consumer, and there is some value in the long end. So again, you know, edging into longer dated gilts, but there's some patience required there, I would have thought, given the inflationary challenges that present.
There's a cautiousness to Ben Guttridge this morning, which is indicative, I think, of what is going on in these markets. Ben, always great to have you on set. Thank you very much indeed on the call around edging in to the long end of gilts, and maybe a little bit of opportunity in terms of the long end of the US Treasury curve, as of course, as well. Ben Guttridge, of course, model portfolio service at Invesco Asset Management. Thank you. Coming up, Austria's OMV, this is a big deal, is in talks with Abu Dhabi to form a chemicals giant. We bring you more on that Bloomberg scoop. It's next. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back. This is Markets Today. European stocks down, selling off by 0.4%. The heaviest losses coming through for real estate after the gains of yesterday. That sector now down 1%. Now to deals, and Bloomberg has learned that Abu Dhabi and Austria's petrochemical company OMV are in talks to create a chemicals giant worth over $30 billion. Borealis is 75% owned by OMV, with the rest held by Abu Dhabi National Oil Company. Let's get the details then and bring in Bloomberg's executive editor for the Global Deals team, Aaron Kirchfield. Aaron, what do we know about this potential tie-up, this potential deal?
Well, what we know is that these talks are ongoing, and they are hoping, if things go well, to possibly reach the framework of a deal, or at least to set the stage for negotiations in the coming weeks. I think the key word for this deal is transformation. You have, on the one hand, the Abu Dhabi side looking to move more into manufacturing, tech, bring that expertise in-house. And then you have on the other side, OMV, an oil and gas giant, looking to kind of pivot away from their reliance on oil and gas and move more into plastics. And by combining the two companies, you could argue you get a company with more scale, more heft and investment to expand in Asia.
Okay, so that's why they're doing this now. What's the broader sort of strategic rationale here, Aaron, behind this merger?
I think it's all about synergies. As BI pointed out, if you were to combine this company, you could compete with the likes of SABIC, a huge chemical company in the Saudi, and some of the European and American players. And it just gives you more, ability to negotiate with your suppliers. It gives you an ability to use the oil and gas coming out of Abu Dhabi to produce these products that the likes of Borealis and Barouge make.
What are the main hurdles to this deal?
So the main hurdles, obviously, we have governments involved here, so there's going to be a lot of kind of tactician and tactical moves in terms of who has what influence. I think the main hurdles are valuation and ownership structure. They need to agree on which company is worth what, how much their stakes are worth, and the balance of power, as it were. So I think they're really trying to strike a balance between setting the right realistic valuations, but also that each one has a voice at the table and that everyone feels like they're benefiting from the deal. So I think it's all about the kind of behind the scenes negotiations, finding price and ownership structure.
Okay, thanks very much, Aaron. Thanks for the update. Bloomberg's Aaron Kirchfield with the latest on that deal. More on the terminal, of course. Abu Dhabi OMV in talks to form a $30 billion chemicals giant. Coming up on the program, medical diagnostics firm Nico Health has raised 60 million euros in venture capital to expand outside its home country of Sweden. We'll be speaking, Tom, then to the company's founder and CEO, one of the co-founders, of course, another of the one of the early investors in this, Daniel Ek.
Yeah, of Spotify.
Famously of Spotify.
Of Spotify. So he's put some money to play. They just raised about 60 million euros. They can be expanding outside of Sweden, and they bring together the hardware, the smart hardware technology, and AI software as well. So we'll see how they are looking to expand that business, the kind of competition they face, and to what extent AI is essential to what they do as well.
Absolutely. AI in the medical space, part of that conversation, of course. Quick check on the markets then, down by 0.5% on the Stock 600 this morning. A down draft, really, in terms of sentiment coming through from the Asia session and what we heard from China around the growth there. MSCI Asia Pacific down by 0.5%. US futures, interestingly, pointing lower, down by 0.4% on NASDAQ futures. E-minis, 0.2% weaker. More on the markets shortly. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today. We're 30 minutes into your European trading day. Let's get to your top stories. China leads Asia stocks lower as a soft PMI services report sours sentiments, with attention now turning to today's Fed minutes. European stocks are down. Brent is moving lower, with traders waiting to hear from the Saudi Energy Minister Abdulaziz bin Salman at the OPEC International Seminar. We are live in Vienna. Plus, Greek Prime Minister Kyriakos Mitsotakis pledges to repay 2 years of bailout loans ahead of schedule. We'll bring you our exclusive interview. Tom, we talked a lot about the China dynamic and the way that sentiment there is weighing through the Asia session into Europe, but we've also had our own bout of negativity coming through in the Spanish PMI story.
Yeah, so the numbers coming through from Spain are pretty ugly, actually, in terms of the print. The latest print for services PMI out of that country, dropping to around 53 from close to 56 in the month before. So still in expansionary territory, but quite a sharp pull-in and below the estimates as well. We're likely to get Italian and German PMIs as well for services towards the end of this year. So it's kind of shaping out just the softness that's coming through now. It had been manufacturing, of course, that had taken the biggest brunt in terms of the hit in Europe, but now we're starting to see some softness in services. It may be welcomed by the ECB, of course, when it comes to wages and jobs, and wanting to see a little bit more softness there. But again, anyone employed in that sector may be a little concerned that that is starting to cool in Spain, which of course has had a slightly more benign inflationary picture. Across these markets, giving up some of the gains of yesterday, particularly in real estate, which led the upside of Tuesday with gains of a little more than 2%. Now real estate taking a move lower. Across the benchmark, you're seeing drop of 0.5% at 30 minutes into today's trading session, of course, this Wednesday. Over in Germany, the DAX is off by 94 points. And here in the UK, the FTSE 100 is back below that 7,500 level with a drop of 30 points or 0.4%. Across your sectors then, some of the standouts, I mentioned real estate. We don't have it reflected here, but again, it is leading the losses, at least the last time I checked, after the gains of yesterday. Energy taking a bit of a hit. We're on the ground in Vienna around that OPEC symposium, and Brent is off again today. So energy as a sector down 0.3%. Technology pricing in some pretty decent losses here, down 1% for the tech sector. Construction also off by about 0.6%, and banks down by 0.3%. Services, financial services also in the mix there, off by about 0.8%. But the heavier losses coming through for technology at this point and basic resources. And again, that links in to the softer China data, Anna.
Okay, so that's a pretty red board, isn't it, in front of us for this Wednesday morning as we wait for US players come back to the market after market closures of yesterday for July the 4th. Let's move on to something else, and AI and its links with the healthcare sector. Stockholm-based medical diagnostics company Nico Health has raised 60 million euros in venture capital to expand outside its home market of Sweden. The preventative medical body scanner maker has some big name backers, including the CEO of Spotify and Skype co-founder Nicholas Jonas Zenström. So let us talk now to Hjalmar Nilsson, who is the co-founder and CEO of Nico Health, and joins us now. Hjalmar, thank you very much for being with us. So we talked a little bit about what the business does. What difference does the technology make at your business? What do your clinics plan to do that established hospitals and healthcare providers can't?
Yeah, so, the healthcare system we have today is really predicated on you go to the doctor when you have a problem, and the doctor is collecting information about the symptoms that you have. And almost by definition, this will not give the doctor or the healthcare system any tools to be preventative or even proactive, which is what we think needs to happen for us to have the healthcare system that's sustainable, both financially and also to deliver the kinds of things that both doctors and patients want. To get there, we think using the traditional healthcare technologies like the MRI and the X-ray and the blood tests, those were never designed to get us there. They are all sort of 50, 100-year-old technologies. So we think a completely new approach, taking into consideration the revolution that has happened with sensors, with AI, those will be the fundamental technologies that creates the possibility to have a more proactive healthcare system. And that's what we're building and designing.
Hjalmar, we're reflecting today on the NHS. The NHS in England and the team at Bloomberg have done a deep dive on some of the failures and the lack of funding and the pressures across that system. I just wondered, do you and other businesses like you in the private sector, do you benefit from the kind of crumbling foundations of some of these nationalised healthcare systems?
Well, I think what's happening is like in basically every Western country, we have the same problem. I know the NHS issues very well. And what's happening is we're trying to apply more and more funding to this existing way of delivering healthcare, but it's getting to the point where it's financially unsustainable, while at the same time, medical staff and patients have never been more unhappy. So we think this is not so much a political problem, because you can look across the world and there are all kinds of different political systems. This is a fundamental problem of what is the kind of healthcare that we're delivering, and is it working, and will it work for the next 10, 20, 30 years? And right now, we have seen that healthcare costs as a percentage of GDP has doubled in 20 years. So if this trend continues, there is no way we can afford to even have the quality we have today. And what is happening then, unfortunately, is that a lot of the funding to provide the healthcare services has to be found in other ways. So private is getting bigger and so on. So we think this is part of the trajectory that we're seeing across time. And with actually applying technology to this problem, we think we can get it back down where you can have way higher quality than today at way lower cost. And this is what technology does, right? So, yeah.
And Hjalmar, I wanted to ask you about the fact that you talk a lot about technology and its role, and that you have experience of. I wonder how much that makes up for the fact that you and your co-founder don't come from a sort of medical background. You spent time commercializing clean tech, initially in the solar industry, then energy data. He, of course, Daniel Ek, the CEO of Spotify, we know him as. So how did you come together and land upon a healthcare idea?
Yeah, so I've been doing AI stuff for 5-7 years. So Daniel actually reached out to me and said, hey, I think we should take on the healthcare system. And he has been really passionate about that for like 10-15 years. And I come from a family of doctors. So my grandfather had his own practice. Both my parents are doctors and professors. My oldest brother is a doctor and a neuroscientist. So I knew, perhaps better than him, the tremendous uphill battle we would be fighting. I saw my family and my parents fight against the system my entire life. So I was kind of dead set against like any market but the healthcare market. But when you actually get into it and you look at both how unsustainable the thing that we're doing is, and also how AI and the abundance of medical data will completely change how healthcare is practiced, at that point it's impossible to say no to, I think, to try to do something there.
Yeah. Hjalmar, on the question of AI, what models are you using? And how do you address the concerns around data biases? People coming from minority groups, diverse groups, may be concerned about some of these models and the data they're trained on.
Yeah, absolutely. So to some degree, our service is quite analog, because we always have a doctor on site with every person. And you get 20 minutes with our doctors to review all of the data, which means that there's always a human in the loop who can make a judgment call, like a highly trained professional. For the AI question, okay, how do we get rid of the biases? Well, it's actually shocking how small the medical studies typically are that is the basis for treatment. So like objectively collecting across big populations, the actual state of healthcare data will dramatically improve how much personalized healthcare we can give, how precise we can be. So, I mean, from our point of view, it's crazy that, you know, your YouTube playlist or your Spotify playlist is way more personalized than your healthcare experience. And the reason for that is, of course, that they have been able to track your data across time so they can cater exactly what you need at the time when you need it. So this is clearly, I think, where the healthcare system needs to go. And that starts with robust, comprehensive understanding of the data.
Hjalmar, Tom mentioned earlier that we're marking here in the UK 75 years of the NHS, and UK data is often talked about as a big opportunity for healthcare providers. I mean, that's not the data you're talking about necessarily. You're talking about the data you're building up in your business. But are you attracted to the UK market then? What are your plans in the UK?
So, you know, we've been told by so-called experts that with Brexit and everything, maybe the UK market should be the last market we look at. But we kind of feel different. We would love to contribute to the UK market. We know there are serious issues there. It's a great country, so we're very hopeful that we'll be able to do something there soon.
Okay, Hjalmar Nilsson, founder and CEO of Nico Health, backed, of course, by Daniel Ek of Spotify. Thank you very much indeed, having raised about 60 million euros. Just a couple of lines to bring to your attention. Hon Hai, of course, based and listed over in Taiwan. June sales coming through at 422, close to 423 billion Taiwan dollars. In terms of sales, that's a drop of almost 20%. This is, of course, the Foxconn business, the listing name, of course, of Foxconn, which makes, of course, among other things, but predominantly the iPhone. Right, coming up, the UK's financial markets regulator plans new reforms that will shake up bonds trading. We're going to get the details next from the FCA Executive Director, Sarah Pritchard. That's coming up in the next couple of minutes. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, you know, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
This is Bloomberg Markets Today. We are 43 minutes into the European trading day. You can see European equity markets on the back foot. Negativity coming through from China. Also, perhaps the story coming through from Spain, a little bit negative when it comes to services PMI. So we're establishing those cracks in the global growth story and thinking about those as we head into the European session or through the European session here. Let me just check on one stock that is certainly moving lower, and that is Casino, or Casino Guichard-Perrachon over in France. The stock really plunging, and I say that advisedly, down by 33% in today's session, as investors are really looking at two competing offers for this business, both of which would leave equity holders with not very much. There's Team Neal and Team Kretinsky, either a French-led or a Czech-led bid here. And the reason that these billionaires are interested in the company is because of some of the prime sites that they operate in the Paris region and other affluent areas of France. And so that's the attraction. The difficulties for the business, though, a long-running saga, not made any better, of course, by the COVID pandemic and the levels of debt that left on the business's balance sheet then, Tom.
Well, it's just become a lot cheaper, hasn't it, that stock at least. To the capital markets of the UK now, and some changes being pushed through by the FCA. The Financial Conduct Authority has proposed setting up a single UK price feed for bond trades before it establishes one for equities. The technology will collate the price, size and timing of trades across multiple trading venues to produce a centralised, near real-time feed. For more, I'm very pleased to say we are joined by Sarah Pritchard, the FCA's Executive Director of Markets and International. Sarah, good morning. Thanks for joining us. Just explain for us what these changes will do for the UK's bond markets, what kind of problems the consolidated tape is aiming to address.
Well, good morning. It's great to be here. As you said, a consolidated tape is an important development in the UK capital markets. It combines multiple sources of trading data into one stream of data. And in doing so, we hope that it will increase transparency, access to data, lower costs, and improve data quality. It's one of a number of measures that we're announcing today as the FCA in the work that we're doing as the Financial Conduct Authority to support strong UK capital markets.
Okay, so that's what you aim to do here. How real-time will the fixed income data be then, Sarah?
We've set out in our consultation paper an ambition for it to be real-time. As I've said earlier, this is a consultation. The consultation is open to September. So we're very much seeking views from industry, from market participants about the proposals that we have included in our consultation about the design elements. We are asking questions around the real-time access to data and about the method of a tender process for the appointment of a single consolidated data tape provider.
So, Sarah, the framework's going to be in place by 2024. Are you facing pressure from industry to kind of step things up, given the developments over in Europe? And what is your time frame? What are you thinking about in terms of applying similar measures around the equities market?
So, as you may have seen, we've set out some early questions in relation to our thinking on equities. We're taking the opportunity of the framework that we are proposing for bonds to ask those early questions now for equities, but our intent is to start with bonds. In doing so, we've taken a lot of industry feedback. We've taken feedback through the UK's Wholesale Markets Review. We've taken feedback from industry over the last months about the design. So we're very much hoping that through this consultation process, industry and market participants will recognise that their feedback has already been taken on board. But as you say, this is a consultation. We want to make sure that we get it right. We want to make sure that critically a consolidated tape delivers for the UK markets.
And Sarah, do you think the need for a consolidated tape in any kind of asset, is it sort of one of the downsides of having multiple trading venues, which of course are designed to create competition, but this is one of the drawbacks? You then need to consolidate all the tape from all those different venues.
It's exactly the reason that we're starting with bonds. We recognise that the data in bonds is more fragmented, less consolidated. So that is exactly why we are starting with the proposal for a consolidated tape for bonds. Other measures that we're announcing today are guidance on the trading venue perimeter and also a new pre-application support service designed to support wholesale market firms that wish to obtain FCA registration.
Sarah, why is it taking so long to produce rules and reforms or rules and regulations around crypto? And how are you thinking about what the SEC is doing over in the US?
In relation to crypto, you will have seen that this is very much the FCA working in lockstep with HM Treasury and our government partners in terms of what the UK regulatory regime should be. You will have seen us repeatedly through the last year or two issue warnings to consumers about the dangers of investing into crypto. We've said if you buy crypto assets, be prepared to lose all your money. And we have acted at pace, not only within the UK, but leading some of the work on the international stage in relation to the crypto regulatory environment.
Sarah, can I ask you about the interest rate conversations that the FCA is currently having with the banking sector on the retail banking side of things? I know that the FCA is going to be meeting with bank bosses, and there's been some pressure applied perhaps to bank bosses already politically around passing through higher interest rates to consumers. What's the FCA's thinking there?
In the last few weeks, I think you've seen the FCA play a strong role in supporting government partners and supporting the conversations around the challenges around cost of living. You've seen us in the last few weeks make changes to our rules to support the key commitments made by the Chancellor at the recent summit. And as you say, we have called in CEOs for a roundtable tomorrow in relation to discussion around savings rates.
And what should we expect from that conversation, from that discussion, Sarah?
I think you'll need to wait for tomorrow's roundtable. The fact that we have called market participants called them in before the press announcements, before the announcements recently, shows how seriously we take this issue. And linked to the new consumer duty that we have coming in force at the end of July, ensuring that there is fair value is important to us as a regulator.
Sarah, there's a redhead crossing the terminal earlier around the FCA probing Crispin Odey and whether or not Crispin Odey is fit and proper. The FCA started investigating Odey back in 2021. Of course, he denies these claims and the allegations around him. Why has it taken the FCA so long?
First up, I'd like to say how seriously we take allegations of non-financial misconduct and how much we recognise the importance of healthy cultures and the bravery of people who come forward when they are reporting allegations of non-financial misconduct. What you will see in that letter that was released this morning is quite an extensive explanation from us as the regulator around how seriously we take issues of non-financial misconduct, the leading role that we've played actually in terms of UK and international regulators in the action that we've taken generally around non-financial misconduct. And I'm afraid in terms of the specifics on the case, I would just refer you to the letter for the details that we've been able to provide to the Treasury Select Committee released this morning.
Sarah, can I ask though, I mean, clearly the investigations into Odey will be taking place. Will you be carrying out investigations into other staff at Odey Asset Management? Will you be monitoring where those staff go? Given some people might want some answers about what they knew and what they said or didn't say and when.
I'm not going to be drawn on the details of what we may or may not do in relation to that specific case. I would just say that we do take allegations of non-financial misconduct seriously. It's right and proper that they are subject to due process and to a formal investigation. And I just encourage anyone in any firm, you've seen us talk repeatedly at the Financial Conduct Authority about the importance of healthy cultures. So please do, if you have concerns around non-financial misconduct, make sure that they are reported to the appropriate authorities.
Sarah, do you think the women involved, do you think the victims are right to feel like the regulators have let them down?
As I said, we do genuinely take allegations of non-financial misconduct very seriously. Many of our firms recognise that, and I hope that the explanation that you will see, I would encourage everyone to read the quite extensive letter which sets out in full detail why we think healthy cultures are important, why we take allegations of non-financial misconduct seriously, and the general steps that we can take without being drawn on the specifics of that particular matter.
Okay, Sarah Pritchard, we appreciate your time. Thank you, of course, on the changes around the bond markets, what's happening with the banking sector, and, of course, the scandal involving Crispin Odey, of course, those allegations that he denies. The Executive Director, of course, of Markets at the FCA for us, Sarah Pritchard. Thank you. Coming up, the UK's National Health Service is 75 years old today. It's a key political issue for Prime Minister Rishi Sunak. We're going to bring you first of its kind analysis. This is the kind of analysis only Bloomberg can do on NHS data. It's compelling, it's shocking. That is next. This is Bloomberg.
everybody want to be a consultant. And what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Today marks the 75-year anniversary of the NHS in England. In first-of-its-kind analysis of the NHS in England, Bloomberg has underscored just how deep problems run in the service. Joining us now for more, Bloomberg's Natasha Doff. Natasha, great research by Bloomberg. Why is the state of the NHS becoming such an important issue then in the UK right now?
Yeah, so the NHS was set up 75 years ago today to provide universal free access to healthcare to everyone. And it's since become an institution that British people love and are very proud of, which is why it's such a big deal that it's now essentially in crisis. It's crumbling under the weight of staff shortages, years-long waiting lists, and spending cuts.
What does it mean in terms of the breakdown? You live in an affluent area, you live in a poor area. Is there an impact?
Yeah, so the data that we analyzed, we basically took 8 different indicators on healthcare provision and how that differs in each constituency, which has never been done before. Usually it's done on individual hospitals. So this is a way of looking at it kind of politically. And what we found was that every single district is failing to meet at least half of the indicators, and almost a fifth is meeting none of the indicators. So for something like, if you call an ambulance due to chest pain or stroke, an ambulance should take 30 minutes to arrive on average. We found that in 60% of constituencies, that target is not being met, so it's being failed. And yeah.
Natasha Doff, thank you very much indeed. You can read the full deep dive into this NHS data that's been analysed by the team. It's really worth doing it on the Bloomberg website. European equities down 0.5%, US futures off by 0.2. Stay with us. This is Bloomberg.
Say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Global stocks drop after the latest data from China shows more weakness in the world's second biggest economy. Fed minutes later today. Now, the Greek Prime Minister Kyriakos Mitsotakis pledges to repay 2 years of bailout loans ahead of schedule. We'll bring you more from our exclusive interview.
We will be able, before the end of the year, to actually repay ahead of time our GLFA facility.
Plus, oil traders await comments from the Saudi energy minister at today's OPEC international seminar after the country and Russia pledged output cuts. We're live in Vienna with Manus Cranny. Now, first thing is first, let's check on the markets. A lot of focus, of course, on data out of China. European stock, you can see a bit under pressure. They really followed some of the Asian shares lower. The latest data from China showing more weakness in the world's second biggest economy. What that means for the rest of the world is that we could see a little bit less support when it comes to, for example, some of the commodity usage break. This is, one of the things that we're looking for is if anything in China's economy is actually breaking the sputtering services industry, raising concern really about the outlook for the global economic growth at a time when most major central banks are still in tightening zone. Now, Euro area June services PMIs also coming in there. Of course, the final reading coming in at 52 instead of the preliminary reading of 52.4. That's pretty much in line with expectations. Again, anything above 50 means that we're in expansionary territory. So Asian equities falling, U.S. futures lower after subdued trading. This is also after the U.S. holiday yesterday. Happy 4th of July for all of our American viewers. Attention now turning to the Fed minutes today. Now, traders seeking insights into why the central bank decided to take a pause in its hiking cycle and what the potential is for more rate hikes. So let's get straight to Christine Aquino and Eddie van der Walt. We have a double duo looking at the market. So thank you both for joining us. Christine, first of all, how do we put into context what's happening in China? How much of a worry is this for the world economy?
Well, quite worrying, Francine. I mean, I think this just furthers the narrative that China really isn't the overwhelming positive story that all of us, I think, were hoping it would be at the beginning of this year. I mean, remember, it was meant to be kind of the growth engine of the world economy in 2023 as it exited COVID-0 lockdowns, and especially contrasting with what's happening in the U.S., right? Tightening policy and fears over that leading to a recession. China was meant to be the counterpoint to that. It's just not playing out.
Yeah, and Eddie, I was in Sintra last week. Of course, that's where Jay Powell was, and he was at pains in trying to explain exactly what he's seeing in the economy, which is they're data dependent, but actually they'll stop at nothing also to do 2%. The markets haven't really quite latched on to the real messaging of that.
Yeah, and it's a really difficult message for them to get across, right? On the one hand, we're pausing. On the other hand, we're probably going to hike later again. And the market just kind of it doesn't know whether to believe this or not. Now, we're getting the Fed minutes. I don't know whether the Fed minutes is going to give us any more clarity, because as you say, Powell's already already spoken at Sintra, and has already given us more than was probably in the meeting. What we're really going to have to wait for, I guess, is for the jobs data at the end of the week, because that's what the Fed is looking towards too, because they want to see whether the economy remains strong and whether that allows them to turn this pause into another series of hikes.
Yeah, and I want to talk about, of course, some of the credit out there in just a second. We're back with Christine and Eddie shortly, but we also had an interview with the Greek Prime Minister. That was yesterday in Athens in his office. Now, the Greek Prime Minister, Kyriakos Mitsotakis, has pledged to repay 2 years of bailout loans ahead of schedule. The yield on Greece's 2-year bond fell after his comments in this exclusive interview with me in Athens.
I'd say the first goal, and I think it's a very tangible goal, is to get to investment grade before the end of the year. I'm very confident that we will actually succeed in doing that. And then in terms of the actual structural reforms, I want to continue making Greece a very attractive destination for foreign investment. We've been very successful in attracting foreign investment over the past 4 years, but we need to keep up this pace. And this, of course, means various interventions when it comes to the business environment. I'm very preoccupied with justice. We need to make sure that we accelerate justice reform and that the courts don't take for ages in order to reach a final decision. And I'm also particularly concerned about offering Greeks quality health care. We have a public health system, a national health system. It survived the pandemic, but it's about time to make some significant changes to make it more efficient.
Prime Minister, you're very confident that you'll get investment grade. When you get investment grade, what does that mean? What does that change in terms of possible extra investment coming to the country?
I think it changes lots of things. There's currently a lot of capital that cannot invest in Greece simply because we're not investment grade. As you know, we are already trading as if we are an investment grade country, but we also need the official stamp of approval by the rating agencies. I think it will further lower our cost of borrowing, which of course is important in a high interest environment. We've been able to defy the trend. The Greek economy is going to grow significantly in 2023. And this is also giving us a fiscal space to further reduce our debt. We will be able, before the end of the year, to actually repay ahead of time our GLFA facility for the next 2 years. And I think this will also send a positive signal to the markets that not only are we focused on growth, but we also want to make sure that our debt to GDP ratio continues to decline at a very rapid pace.
Is this a promise to? Yes. It's a promise to what
we will
investors?
Repay, yeah, we will, and it's a commitment to investors. We will accelerate the reforms, and we will make sure that whatever reforms we implement will be done in such a way not to compromise our country's fiscal position. Greece went through a lot, through a very painful period. We will never, ever relive these difficult times. But I think we've proven that you can drive high growth, you can reasonably reduce taxes, while at the same time maintaining very healthy public finances. And I do expect our debt to GDP to continue to decline significantly. And of course, again, this will also give us the fiscal space to make sure that we ensure markets that we're serious and actually repay part of our debt ahead of time.
Well, that was the Greek Prime Minister talking exclusively to me on his message to the markets. Joining us for more on what Mitsotakis had to say, Paul Togbo, who's, of course, in the room with us. He's Athens Deputy Bureau Chief. Eddie and Christine are also still with us. So, Paul, Prime Minister Mitsotakis is very ambitious in what he wants to achieve. Will he manage to deliver for investors?
Good morning, Francine. Indeed, very ambitious, but as the old saying goes, where there's a will, there's a way. And he certainly has the will to bring forward what he sees as key structural reforms. We should point out that these reforms are what markets are expecting, and especially the rating agency, in terms of what Greece needs to do to regain investment grade, which is the holy grail for Greece. In terms of those reforms, the 3 areas that he wants to focus on in particular are reform of the judicial system, the health system, and the education system. Probably the most difficult of those is the judicial system. As we know, Greek courts are notoriously slow at reaching decisions. And as part of his efforts to make Greece even more business-friendly, investor-friendly, as he wants to carry on boosting FDI that is coming into the country, it's important for companies to know that if there's recourse, for whatever reason, to the courts, they don't take ages to reach a decision. He's a very hands-on prime minister. He lets his ministers get on with the job, but he's in constant touch with them. He regularly visits ministry to see the progress of work. And as we should point out, this is his second term, and he already has a track record of being successful in reforms. In his first term in office, he managed to bring through legislation to help Greek banks reduce non-performing loans and also reform the labor sector. So he has a track record, he knows what he wants to do, and has the will to do it.
Yeah, Paul, and we also spoke, of course, about the IPO for Athens Airport. He sees that early next year. We had a conversation about, for example, how he wants to recalibrate ties with Turkey. But with little to no opposition in Parliament, can he actually get all the reforms through, quicker than any other prime minister in Europe?
In theory, yes. I mean, his majority is such in Parliament that he will have no opposition to anything that he wants to bring through the chamber in terms of legislation. Just to give people an idea of that, he has 158 seats in the 300-seat parliament. And the next biggest party, the Syriza party, only has 47 seats. And in terms of censures brought against the government in terms of what it wants to do, under parliamentary law here in Greece, you need 50 MPs to do that. And as I said, the second party only has 47. So he really has a clean slate to bring through whatever legislation he wants in parliament. There may be more voices against what he wants to do, as the new parliament in Greece has 8 parties compared to 5 when he was last in government. But in spite of that extra noise in parliament that's anticipated, he's in a very strong position to bring through whatever legislation he wants.
Paul, thanks so much. Paul Togwald, our Deputy Bureau Chief in Athens, joining us today. Now, Christina and Eddie are still with us. Eddie, when you look at, what Mitsotakis has said, stepping up the reforms to try and confine, I guess, the Greek crisis to the history books, I mean, how in this context is Europe doing as a whole? We know, we've talked about this before, that U.S. investors still see it as a problem child worldwide.
Yeah. Francine, first of all, I must congratulate you because you extracted some really robust language from him in that interview where, he's made a real strong commitment to this. But to your point, it's exactly right. This shows just how far Europe has come, right? The last time around in the last crisis, Europe was the problem child. And we saw that in the banking crisis this time around as well, that it was much more centered on the US. And Europe just looks a lot more stable and a lot less panicky and is able to meet these challenges, coming out looking quite robust.
Yeah, I wonder whether, Christine, though, like valuation-wise, there's still quite a lot to go for European stocks.
Absolutely, Francine, yeah. And I think, at this point in time, the value proposition is something that has always been kind of the main appeal of European stocks, right? But it hasn't really quite come to fruition in terms of really kind of shifting their appeal and shifting some of those investors in the U.S. away from that area and back into Europe. And so, in the second half, I think that's really going to be, it's going to be one of the areas of focus, but also simultaneously, especially when we get another round of earnings pretty soon here. I think the question for the second half for a lot of companies here is more than valuations, kind of what their outlook is going to be, how they're going to be preparing for the tougher times ahead potentially, and also their margins and how they're going to be able to keep up those profit margins and whether they're going to be able to keep passing on those higher costs to consumers. It's because there is lower tolerance for that now.
Yeah, it's incredible. I saw an analyst note yesterday saying, look, it's really tech that's driving US. Here in Europe, we have fashion. I don't know what that means for prospects going forward. Coming up, more from our exclusive interview with the Greek Prime Minister. Thank you both. Both Eddie and, of course, Christine will stay with us. We'll get their views on China. Don't miss that. That's next, and this is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, Their product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is a pulse. I'm Francine Lacqua here in London. Now, the Chinese President Xi Jinping has called on nations to spur decoupling and the disconnect of supply chains. Now, Xi made the appeal a day after his nation posed limits on exports of two key metals used to make chips.
China stands ready to work with all sides to keep to the right direction of economic globalization, oppose protectionism, unilateral sanctions, and the overstretching of national security, and reject the moves of setting up barriers, decoupling, and severing supply chains.
And back to our exclusive interview with the Greek Prime Minister, Kyriakos Mitsotakis. This is what he told us about his hopes for relations with China.
We can work with China on various issues, but they're also a competitor, they're also a rival on many other issues. But I've been advocating for a comprehensive European approach vis-a-vis China. So we don't want to decouple, and frankly, we cannot decouple, but we want to de-risk.
Well, Christina Kino and Eddie van der Walt are still with me. Christina, I'm not sure what to do with China at the moment because China data is not looking good. We're not really getting enough support from PBOC or some of the policymakers. And then there's all these extra measures they're putting on preventing them to actually sell some of their very important stuff.
Yeah, absolutely, Francine. I mean, I think this just adds another layer of uncertainty with regards to how investors treat China. As you mentioned, I think at this point in time, that extra layer of geopolitical tension, of course, that this creates, probably not helpful when it comes to sentiment, right? And so I think some of the things that kind of, my initial reaction to the news actually was kind of ringing some inflation alarm bells as well, because, continuously trading bars between the U.S. and China, not particularly helpful. And of course, the question is going to be, what is this going to do in terms of the prices of the goods that are kind of caught in the crossfires of this?
Yeah, so what are we doing, Eddie, for when you look at China and some of the things that they've put in place? I mean, what does this tell us about how belligerent they want to be with the West?
Yeah, look, it's I think these are obviously significant moves, but it is not Trump-era escalations that we're seeing, right? We're talking about gallium and germanium, two particular metals that are used in chips and in other, important sectors like solar panels and so on. But it's clearly not an escalation of the scale that we had back then. So I think China is trying to strike a very, very intricate balance here in that they want to look tough without acting too tough. And I think as long as that's the case, that's okay. But I think we've got to remember that we're coming up to a US election and both parties want to take on China. And I think, so I think over the next year, this theme could just, expand significantly.
But are we decoupling? Is there any chance that we're not decoupling, given also that Germany gave $10 billion to Intel to try and also do a factory to actually stop its dependence on manufacturing of chips?
Yeah, whether we'll see a complete decoupling of global supply chains, I think that's uncertain. But I think companies will want to have contingencies in place because they don't want to have the exposure, not just because of the trade wars, right? But also because of what we saw during the COVID crisis. The companies saw that they are not robust, they are not secure if they don't have control over much of their own production. So I think they want to have contingencies in place. And countries are looking at this more and more. So yes, I think this will be a slow drumbeat to that sort of deglobalization that we've seen so far in the post-pandemic period.
Yeah, and how much will that take hold for actually supply chains as well?
Well, frankly, I mean, it could be quite a significant shift. Again, this idea of decoupling and friendshoring, I think this kind of creates the potential for the process of supply chains to fundamentally change from here. I think, you know, we can treat this as kind of the post-COVID era of supply chains. As Eddie mentioned, I think, you know, the pandemic really showed the vulnerabilities of global supply chains. And then, of course, we saw as well the impact of that when it came to higher prices. I mean, that's one of the contributors to the inflation issue that we're facing now. And so I think the idea of kind of countries trying to create contingencies, even if they don't completely decouple, this has the potential to usher in a new era of how countries and companies really think about supply chains, really think about how they make those more robust and potentially avoid some of the issues that we're facing now.
All right, thank you both, Christine and Eddie there, Christina Kino and Eddie van der Walt from our MLive team. Check it out, it's a great, great blog on the terminal. Now you can watch, of course, our full interview with the Greek Prime Minister Kyriakos Mitsotakis on Leaders with L'Aqua, and that's on the 19th of July. Coming up, we go live to Vienna, where OPEC's conference is taking place, bringing together some of the world's biggest oil producers. That's next, and this is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The top names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
We're going live to Vienna now, where OPEC's international seminar kicking off. The conference starts at an important point after Saudi Arabia announced earlier this week it would extend a voluntary production cut, with Russia also saying it would reduce crude exports. Well, joining us now from Vienna is the one and only Manus Krani. Manus, as OPEC meets, how bad is the demand for outlook globally?
Pretty darn bad. Just look around you. It's the graveyard of a global manufacturing recession. Yes, we might be flying like Billy-O, and I have in the past 3-4 weeks. I've consumed more jet fuel than your average traveler. But that's not going to save the oil price. Let me give you a clue. Jet fuel is about 5% of global demand. You've got China, the Caixin this morning under pressure. You've got European recession. The 12th straight month, we're sub 50 on the PMIs. America, the worst since, longest run of drop since 2008. And the whole of Asia is under pressure. Now, there's an old saying. A friend of mine went to see U2 play a few weeks ago, actually a few months ago, and he said, Manus, you can't put lipstick on a pig. And that's what we're looking at. We have a global manufacturing recession here. You can only control a certain number of variables. You can control what goes into the pot, i.e. the overall supply from OPEC+. But what's happening is this unilateral cut from Saudi Arabia, that's been extended. The Russians got on board with another 500. Now, here's the nuance. They've said they'll cut exports by 500,000 and they may cut production by 500,000. But there's only one piece of that jigsaw that you can trust. It is the export data, because that is the data that will be verified, so to speak. Right now, they are desperately trying to put a floor under this price. Hence, the preemptive action by His Royal Highness Prince Abdulaziz bin Salman, who walked through those doors, and apparently he said, I had a good time in New York last week, but nothing about the market.
All right, what's the impact of the Saudis on extending their unilateral cuts, and their unilateral cuts, and Russia making this additional cut?
I think this is about the royal alignment. Think about it. Riyadh and Moscow. This is a symbiotic relationship that needs to be proven to the world, is robust, it is strong. One has an economic dream, as I said 3-4 weeks ago when I was here, to keep alive, which is the Saudi dream of Neom, Alula, etc. And that's going to cost $80 or $100, according to the Bloomberg data, on a fiscal break even. If you want to make all the dreams come true, then you've got to keep that alive. And Putin needs oil for war.
Thank you so much, Manus Krani, there with the very latest on OPEC. We'll have plenty more from Manus throughout the day. Now, coming up, Blackstone Global Co-Head of Real Estate, Kathleen McCarthy, joins us. Don't miss that conversation. That's next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
Global stocks drop after the latest data from China show more weakness in the world's second biggest economy, will Fed minutes out later today. The Greek Prime Minister Kyriakos Mitsotakis pledges to repay 2 years of bailout loans ahead of schedule.
We will be able, before the end of the year, to actually repay ahead of time our GLFA facility.
Plus, oil traders await comments from the Saudi energy minister at today's OPEC international seminar after the country, along with Russia, pledged output cuts. We're live in Vienna. Now, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, rising interest rates and falling property values are heaping pressure on the commercial real estate sector. The hit from higher rates is being felt mostly in Europe. Now, in the U.S., more than a fifth of office space lies empty in several major cities. Let's discuss all of this with Kathleen McCarthy, Blackstone's global co-head of real estate. So, Kathleen, thank you so much for coming on. There's so much to talk about when it comes to commercial real estate and real estate in general. Where at the moment are you seeing value?
Well, thanks, Francine, for having me. It's great to be on with you. I would say in real estate, what you own matters today. And our portfolio is over 80% concentrated in the top performing sectors. And that's because starting over a decade ago, we said we want to position our investors' capital in the asset classes where we see long-term macro demand trends outpacing new supply. And we want there to be cash flow and cash flow growth so that if we found ourselves in an environment like we're in today, where rates are higher for longer, we could combat the pressure on valuations with cash flow. And so 40% of what we own is in logistics assets. A huge portion of our portfolio is in rental housing, and then hospitality, data centers, and lab office as well. And these sectors are performing extraordinarily well.
Yeah, so you're extremely diversified, but how much stress are you seeing in certain parts, or how much redemptions, for example, are you still seeing in B-REITs?
Well, what I would say is that performance matters, and B-REIT included. B-REIT has generated a 12% net return since inception. That's 3 times what the public markets have given investors. And so while certainly there's some repositioning of investor portfolio, we see both with institutional clients and, of course, with individuals and investors as well, performance is what leads to the opportunity to attract more capital. And so I think in an environment like today, these investors are gravitating towards us, and you saw this with our $30 billion record-setting global capital raise, because they see us as having generated strong performance in lots of different kinds of environments and able to capitalize on the dislocation today.
But are you having to sell anything off to actually raise liquidity? So is it, you have these performing units or performing real estate, and one does well, so you sell it off to make sure that you have enough for the rest?
Well, we are able to be very selective sellers. We have designed all of our different pools of capital to make sure we are not under pressure to sell. Right. We want to be able to protect value and to really grow valuations, even in a dislocated environment. So where you see us selling, it's where we're seeing well-capitalized buyers able to pay attractive values from our perspective, and where we can capture those wins for our clients. So just last week, we announced a $3 billion transaction with Prologis, where we're selling assets in the logistics space out of our opportunistic fund. These are assets where we have grown cash flows, and really we've done the work we need to do for our opportunistic investors. Similarly, in B-REIT, again, showing the real contrast in markets. Right. There was a week full of news about the challenges in San Francisco hospitality assets, and yet in San Antonio, Texas, we were able to sell an asset for $800 million, generating $275 million of gain for our clients. And so the power of being a selective seller is that, again, you can generate great performance. It's really on the other side of that where we see other owners who maybe do have liquidity pressures whether it's public companies that need to generate liquidity to delever, or managers who have not designed their funds to withstand some of those redemption pressures, we're able to transact and purchase assets, act quickly, speed and certainty. That translates into value, and we see that as an opportunity in this environment.
So, Kathleen, where are you seeing the most stress? I know, for example, warehouses are extremely sensitive to higher interest rates. What happens to those kind of units?
Well, I'd say really the greatest stress is probably in the older U.S. traditional office space. But again, I'd say you can't even just look at office as one big thing. Particularly the quality of the office and the location of it matters tremendously. And so, actually, I would say logistics is at kind of the other end of the spectrum, generating very strong performance here in the UK, where we have last mile logistics assets. We're seeing new leases signed at rates 50% higher than older leases. And that is, kind of consistent with what we're seeing for logistics, particularly in more urban locations around the world.
So how are you expecting the market to try and adapt to some of these situations? Are you already seeing or will see, for example, some of the banks sell off their, non-performing real estate loans?
What we know is that in a market that becomes more capital constrained, so the availability of debt is more scarce and that rates are higher, is that it really, again, favors well-capitalized buyers. And so I think what we're seeing right now, and you can look at this in our transaction activity, 90% of what we've done year to date is really in our top couple of themes, in particular, housing, including student housing here in the UK, logistics, lab office. And that's partly because sellers are disposing of some of their best quality assets that have appetite from investors like us so that they can deal with pressures elsewhere in the portfolio. And so I think, oftentimes, again, we see those kinds of assets come out kind of early in these moments in the cycle, and we create those kinds of opportunities for our clients.
So especially in the UK, or are there other pockets of opportunities like that in Europe?
Well, we have been one of the UK's most active investors for probably 20 years or more now. And we are seeing great opportunities in the UK. I think sometimes what we find is that when sentiment gets really negative, prices decouple from fundamental value. And again, for us, we just have a practice of trying to quiet that noise, look at the information in front of us. Again, I can point to that really strong performance in our UK logistics portfolio. We're seeing similar things in UK student housing, where, UK education is one of the most sought after things in the world, and yet there aren't enough beds by a long shot to supply housing for all of those students. And so we keep going in those themes. And again, a little bit of negativity, negative sentiment can sometimes create the best opportunities for us.
How do you call it bottom, though?
So I don't think we ever try to say we've kind of hit bottom. You don't get an all clear signal from the market. And so what we do is we just stay present. We stay attentive to the insights and information we have. We have more data than any other investor on the planet. We have $600 billion of real estate, 12,000 assets. That's feeding us information and insights to drive where we transact. And that's why, particularly in a market like now, where you see a lot of uncertainty, we're going to be very selective, but not be afraid either to kind of lead into where we see strength short-term and over the long term.
Kathleen, I keep on hearing that actually European commercial real estate is frozen because there's a mismatch between what buyers are ready to pay and what a lot of the sellers are asking for the price. When does that come to a head? Does it start normalizing soon, or are you going to have these frozen assets?
Well, I would say really probably starting a year ago, all over the world, you saw transaction activity become a bit more muted, and that's again because, like you're saying, the sellers and buyers may have different expectations on the price. But we've actually been able to continue investing. In Europe alone, we've invested 3.5 billion euros this year, again, all really thematically based around what we like. And so what I expect to happen is, and this is typical in our experience of doing this, is that it takes a period of time for sellers to kind of recognize that it was maybe time to move on, or maybe time to settle into some new pricing, and then you start to see the valuations pick up again. And oftentimes some of the earlier transactions are in and around public companies. We have more experience than anyone transacting with public companies. We've done 50 take privates in our history, but it's not just the take private activity, it's the ability to purchase assets and do that quickly and with certainty that public companies need.
And Kathleen, you seem to be suggesting you also almost want to be a stabilizing role, right? For this asset, which frankly is seen as the next hot thing that could really create something ugly like on the markets. When will that come to a head? Is it impossible to call?
Well, I would say we're seeing opportunities already, and I think it's just continuing to sift through kind of what are the best ones. And again, what an environment like this does is it really favors folks who are well capitalized like us, who have the ability to navigate an environment where you may have less leverage, or you may want to, as a lender in our debt business, really use this as an opportunity to lend into the best borrowers, with the best asset classes. And that, in an environment where banks are pulling back, where people are regulating some of their transaction activity, you can really find great opportunities. But there's not a day where you say, okay, we are now at bottom and it's time to go. I think you just keep finding those great opportunities, and we do think this will be a really transaction-rich environment.
Kathleen, thank you so much for coming on today. That was Kathleen McCarthy, Blackstone's global co-head of real estate. Coming up, we asked why European bank valuations are still behind their U.S. peers. Don't miss that deep dive into the banking sector. That's coming up next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
Welcome back to The Pulse, everyone. The UK's financial regulator says it's investigating whether Crispin Odey passes its fit and proper test to operate in the financial industry. Now, in a letter to British lawmakers on Monday, the FCA says it's focusing on allegations that Odey dismissed the executive committee at Odey Asset Management for, quote, an improper purpose. Well, the FCA executive director spoke to us earlier.
I'm not going to be drawn on the details of what we may or may not do in relation to that specific case. I would just say that we do take allegations of non-financial misconduct seriously. It's right and proper that they are subject to due process and to a formal investigation. And I just encourage anyone in any firm, you've seen us talk repeatedly at the Financial Conduct Authority about the importance of healthy cultures. So please do, if you have concerns around non-financial misconduct, make sure that they are reported to the appropriate authorities.
Now, for more on all of this, let's go to our Bloomberg legal reporter, Jonathan Browning. Jonathan, I mean, what do we know so far? This is a case that, every day there's something that looks worse.
Yeah, there is. And the major new revelation today was that the FCA acknowledged that some of the allegations that have been reported about Crispin Odey, and to be clear, these allegations that he has denied, but these allegations are potentially criminal in nature, and that they have been in contact with the police. And that opens up a potentially whole new law enforcement process.
So what's next in the investigation?
So for the FCA, there will be an investigation into Crispin Odey himself, whether he's considered fit and proper, which is the regulator's broad assessment about whether someone has integrity to operate in the financial services space. They are also looking at Odey Asset Management, the firm that bears his name. And then there is a question mark now as to whether or not the police themselves will respond to the FCA's contact.
But Jonathan, so far, so they're winding down, right, most of the funds. So even if he's not found to be fit and proper, what happens to Crispin Odey and Crispin Asset Management?
I mean, it's very hard. Odey Asset Management is it's very hard to see how the firm in its current shape can continue. The fund managers are going for the exit. Investors are pulling funds. The banks that serve as brokers to OAM have also cut ties. We are yet to hear from Crispin Odey himself. His lawyers are not responding, except to say before that he has just denied the allegations. So we wait to hear on that front.
All right, Jonathan, thank you so much. Bloomberg's legal reporter there, Jonathan Browning. Now, let's also switch focus to Europe's banking industry. The sell-off in bank stocks triggered by the collapse of Credit Suisse and several U.S. regional banks may be over, but the sector's recovery is faltering and actually suggests investor angst will persist. Philip Richards, Bloomberg Intelligence's senior banks analyst, joins us now. So European bank share prices have failed to return to levels before the U.S. regional banking crisis. Are fears over liquidity and deposit flight remaining?
Actually, it's a bit different to that. We don't see any sort of liquidity concerns for the banks. Actually, deposits balances have been very stable in the first quarter results, and in the second quarter, in a couple of weeks' time, we expect that to be the case again. Where our concern is actually on the earnings side of the banks, and until now, the banks have done very well with interest rate hikes. They've been passing that on to their mortgage costs, etc., but not passing it on to savers, and therefore they've been able to widen their margin. However, where we are now is that the rates are almost at their peak levels. And then they have increasingly passed more and more of that across to savers. And that's really going to squeeze their margin and therefore potentially drive revenues down.
So why do European banks continue to lag U.S. lenders in terms of valuations, trading at much lower multiples?
Yeah, well, part of it is simply the economy. The economy in the US is doing much better than it is across most countries across Europe. The regulators have seen a more favourable environment in the US. And then thirdly, simply on profitability. You've got JP Morgan generating about 15% return on equity, and the other US banks, well into double digits, whereas the European banks are typically at 7 or 8%. So simply those factors are important, but also just in terms of that whole dynamic I was talking about earlier, and those are passing on those rates. But it looks like actually revenues might have peaked. Basically, we're at a turn of the earnings cycle.
So, Philip, higher interest rates in Europe have, of course, led to earnings estimate being raised for European banks. So why has this not lifted share prices?
Yes, I mean, this is what we've been hoping for the last 8 years. We've had negative rates across Europe, and now we finally got it. We've had this 25% increase in profits, and yet the share prices, as you show in the chart there, have pretty much stayed flat for several months now. And therefore, the actual valuation, the multiples of the two, are actually basically at multi-year lows. Part of that is just a whole fear that if you are at the turn of the earnings cycle, and that's going to lead to estimates being downgraded. Another example is costs have been growing about 6 or 8% in the last year. That didn't matter when revenues were growing at a double-digit rate. But if revenues are now going to be stable and significantly lower, then suddenly the banks have got negative jaws, as we call it, or rising cost-income ratio because costs are growing faster than revenues. And then lastly, of course, we are going into a slowdown. Bad debts, what happens to them in a slowdown? Typically they go up. So all three of the lines, revenues are flat, costs are still high, and bad debts going up. It's not a good combination.
Philip Richards, thank you so much, our senior bank analyst at Bloomberg Intelligence, joining us on this important report. Now, also making news, global temperatures hit a record on Monday, underscoring the dangers of failing to tackle climate change. The average worldwide temperature was 17 degrees Celsius, just above the previous record reached in August 2016. Now, that's according to data from the National Centers for Environmental Prediction. And French supermarket group Casino says it's weighing 2 rival rescue plans. An offer made by a group known as 3F, led by 3 French businessmen, would inject 900 million euros of fresh money into the business with an equity portion of 450 million euros. A rival proposal, led by a Czech financier, would inject 1.3 billion euros in equity. Now, the rival bids are the latest in a long-running saga for Casino, which has been seeking to cut debt. Its concentration in areas heavily reliant on tourism backfired during the pandemic, and a strategy to raise prices more than its competitors also added to its troubles more recently. And Bloomberg has learned that Abu Dhabi and Austria's petrochemical company OMV is exploring a merger of Borouge and Borealis to create a chemicals and plastics giant worth more than $30 billion. Now, the talks are said to have been ongoing for several months. Vienna headquarter Borealis is 75% owned by OMV, with the rest held by Abu Dhabi National Oil Company. Now, coming up, the UK's National Health Service is 75 years old today. It's a key political issue for the Prime Minister Rishi Sunak, so we'll bring you first-of-its-kind analysis of Bloomberg by Bloomberg of NHS data. That's coming up next, and this is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The conversations that matter, the insights you need. This is A Pulse. I'm Francie Lacqua here in London. Now, here in the UK today marks the 75th anniversary of the founding of the National Health Service. First of its kind of analysis of the NHS in England, Bloomberg has underscored just how deep problems run in the service. It shows, for example, that almost every single area of England is failing to meet even half of 8 key government indicators, from bed availability to ambulance waiting times. Well, joining us for more is Bloomberg's Olivia Konoti-Ahulu, who worked on this deep dive. Olivia, always great to have you. You do some great work, and I urge everyone to go and read some of the deep dive. So what exactly is the root of all these problems?
Well, I think there's two things, because on the one hand, you've got an NHS with a huge amount of demand. You've got an aging population, a backlog from COVID, and when people are older, they're having kind of a greater number of quite serious issues. So there's that kind of stress. But then on top of that, you've got an NHS which is pretty largely agreed as underfunded, understaffed, and the staff who are there are really overworked and really stressed and feeling undervalued, particularly with the cost of living crisis after COVID. So you've just got a health system which has got a huge amount of strain on it at the moment.
So, Olivia, what exactly has been the impact of Brexit?
Well, I think one thing which we all remember is kind of the figure passes on the bus about how much money would go to the NHS from Brexit. And I think some people have kind of had difficulty in seeing where that's been emerged. But then the key thing is staffing. So when it comes to professions such as nursing and social care, we used to rely really heavily on the EU. And the fact is that even when nurse numbers do rise, there's just the demand is so great, and to match the needs of the population, we just still need way more, essentially.
So is this only, how much of this is a funding problem? Like how much of it is a staffing problem, a funding problem, and what's the way forward?
Honestly, it's difficult to say, because some people it's also about how the money is being used, and that there's different ways potentially that the system could be adapted. Some people say there should be reform. Some people say that we've had enough reform. The government this week actually put out a workforce plan, which people have really been kind of anticipating, hopefully to answer some of the staffing issues and to bring more people into the NHS. But I would honestly say it's both. But I would say that the underfunding issue is a very, very common theme, not just even within the NHS, but all the services around it that kind of keep the population healthy, which prevent people from going to hospital in the first place. People are saying that there's just more money needed in those areas as well.
Olivia, thanks so much. Bloomberg Equality reporter Olivia Konati-Ahulu there joining us. And of course, Olivia also joins us tomorrow for a deep dive on the NHS. That's at 9:30 a.m. tomorrow morning in our half-an-hour special focused on the UK. Now, we continue also looking at central banks. We have a European Central Bank Governing Council member and president of Banca d'Italia, Ignazio Visco, hitting back at colleagues who basically say that policymakers should not worry about raising borrowing costs too far. Now, this has been for quite some time the line of Italy saying the ECB is to blame for any kind of trouble at home because they're raising rates too quickly. Now, it's very clear that Mr. Visco's various remarks that have just come out and crossed the Bloomberg terminal appear to counter those from Hawks, such as executive board member Isabel Schnabel, who said just last month that the central bank should err on the side of doing too much. That was Mr. Visco talking there. He's one of the more dovish officials at the ECB, and he spoke weeks before a decision where officials really have effectively committed to raising rates again by a quarter point. That was the message in Sintra, Portugal last week, and that was very, very clear. Now, before we let you go, let's check on the markets. It's all to do with China and some of the data that was disappointing from China. European stocks seeing a bit of pressure as the latest data from China showed that there's more weakness in the world's second biggest economy. Again, it's the sputtering services industry, which is really raising concern about the outlook for the global economic growth at a time when most major central banks are still in tightening mode. Now, another reminder that you can also watch our full interview with the Greek Prime Minister. He's Kyriakos Mitsotakis. That's a special edition of Leaders with Lakwa. That's on July 19th throughout the day. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Guy Johnson in London, and this is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
10 a.m. in London, 5 a.m. in New York. That means it's 5 p.m. in Hong Kong. Our top stories today. China's services industry growth slowing sharply in June, providing more evidence that the key driver of the post-COVID recovery is now cooling. U.S. markets reopen after the Independence Day holiday. June Fed minutes today may shed some light on the path of future rate hikes. And oil retreats. We're live in Vienna as traders await commentary from the Saudi energy minister at the OPEC International Seminar. Welcome to Bloomberg Surveillance, the early edition. I'm Guy Johnson in London. I'm stepping in, of course, for Danny Berger. Kriti Gupta is, though, back in New York. Kriti, let's talk about these markets. You guys got yesterday off. To be honest, you've had a few days off. What are we looking like? The back end of the week looks fairly busy.
Yeah, I'd argue today might be an extension of just that dynamic. I wonder how many people are actually showing up to work today or even paying attention while sitting at the desk, which might explain some of the market action we're already seeing, Guy. A little bit of a pullback you are seeing in futures, down about 0.3%, but this was kind of expected. You see when you have a little bit less participation, a little bit less volume, you are going to see that pullback. But there is a narrative at play as well. Some weaker data coming out of China weighing on the global economic outlook. And remember, this is coming ahead of that payrolls number we're going to get on Friday. So perhaps a little bit of cautious optimism. I feel like I could support that case from both a fundamental and a technical point of view. Nevertheless, 44.80 on those futures contracts. Also seeing a bit into the bond market. Again, kind of typical when you see that cautious trade. 490 on the front end of the curve, down about 3 basis points. If you go further out, down about by the same measure. But again, I think a lot of it is coming down to China. The idea that a key driver in that recovery really has global implications. And that's really where you're starting to see weakness in the yuan kind of tried to get stemmed as much as possible. China coming out and saying we are going to add more liquidity measures to really stem that plunge. Nevertheless, it doesn't seem to be working. Check out the dollar versus the offshore yuan. The offshore yuan is one of the biggest drivers of the Bloomberg Dollar Index this morning. So you are seeing that currency pair trade about 7.25. The dollar stronger by about 0.4%. But Guy, if we're worried about recession as a function of inflation, shouldn't the commodity trade be a little bit more volatile? We haven't really seen that when it comes to NYMEX crude, still trading at a 70 handle, although higher by 1.5% this morning.
So I'm going to just throw a bit of cold water on that idea. You saw the move Friday from Saudi and Russia. That got priced into Europe yesterday. So European crude, Brent, went up. It's softening today. You guys are just playing catch up. It's just a little bit of a catch up trade, or as Alex Steele would say, a catch up trade. But anyway, we'll do that joke a little bit later. Kriti, we are seeing Euro area data dropping onto the screen right now. It's May producer prices. They're down by 1.9% month on month. The estimate was 1.7. Basically, this gels with, for instance, the ISM data we saw on Monday that we got out from the United States, which basically showed the prices paid falling really quite rapidly. And I think that's a consistent theme that we're seeing. It's going to be interesting to see what impact that has on margins for industrial companies. Let's talk about European stocks today. We are a little bit softer. It is the China trade, as Critty lays out. It is very clearly the China trade that is having an impact on Europe. You're seeing areas like the basic resources, the miners, Critty under a little bit of pressure. Casino is a stock that we are watching out for today, though. Casino, as you may call it, the French grocer, absolutely front and center right now. The stock bouncing around all over the place. I don't have a percentage for you there, but you can do the maths on that one. Stock 600 down by 0.5%. Euro dollar fairly flat. Big end of the week, but China is dominating today, Critty.
Absolutely, and I want to get a little bit more analysis on that China story because, look, we get a lot of data, we get a lot of liquidity measures, but let's have a reporter properly cover this. China services growth softened in June, as we both talked about, indicating that the recovery this year losing a little bit of momentum. Consumers scaling back. The data could spur more calls for the government to ramp up measures to support growth. Some evidence of that already shaping up in the market. Joining us now is Bloomberg senior China reporter James Mager, joining us from Beijing. James, walk us through the data here.
What you saw in the services data, which we had today, was another indication that services trade, people spending on restaurants, going and traveling, that kind of thing, has really weakened. It's fallen now for 3 months in a row, and while it's still expanding, it's much weaker than I think everyone had hoped for coming into this year. When the hope in January and February this year was that as China came out of COVID zero, you would see a massive jump in consumer spending, the kind of jump that you saw in other countries when they came out of their own lockdowns in previous years. And that happened for a few months, and then it's really tapered off in the last 3 months. And it's coming as well as the industrial sector is also really struggling. Exports are struggling. Manufacturing is in contraction according to the PMI data. So consumer spending was really the only leg of the economy that was really working well. And as the data today shows, that's not the case anymore. So it really is quite a negative picture across the whole of the economy in China at the moment.
And we are getting commentary from the leadership as well. James, hold that thought for a moment. Xi Jinping calling upon nations around the world to reject economic decoupling. He was speaking at a virtual event to an event in Shanghai, the Shanghai Cooperation Organization Leaders Summit. This is what he had to say.
China stands ready to work with all sides to keep to the right direction of economic globalization, oppose protectionism, unilateral sanctions, and the overstretching of national security, and reject the moves of setting up barriers, decoupling, and severing supply chains.
James, isn't this a case of do what I say, not as I do? We're in a situation where only a couple of days ago, we saw China retaliating by restricting key metals into Europe and into the United States. I think we may be having a few little... James, we're going to... James, hold that thought. Sorry, we're having a few technical issues, as our audience probably are now aware. James Mager in Beijing. Critty, this is the issue, isn't it? It is do as I say, not as I do, because we are now seeing increasingly this ratcheting up of tensions as we watch very carefully the US restricting key technology and the flow of it into China, but China then responding in kind, basically saying, we have the metals, you don't. We're going to restrict your ability to buy them.
Yeah, there's an element of deja vu here. Remember when we went through this kind of saga with the rare earths conversation? Essentially, the idea here being that a lot of the Western countries were kind of diversifying away from China because of that. And then China said, look, we're just going to limit those exports even more, kind of limiting that diversification. And I think there's a lot of concern here in the market about just how quickly that transition happens. But I mean, we still have to keep in mind that the metals that are specifically being targeted here aren't actually the main metals. They're not the bulk of the metal. So how much of this move is really symbolic, Guy?
Absolutely. But as you say, what does it symbolize? It symbolizes maybe a ratcheting up of tensions. Let's stick with the commodities theme, Critty. Over in Vienna, OPEC's international seminar kicking off. This is a biennial event. The conference comes, of course, after Saudi Arabia announced earlier this week that it will extend a voluntary production cut. It's doing so with Russia. Joining us now, Bloomberg's Manus Cranney. He is in Vienna. Manus, the Saudi energy minister has just been speaking there. Russia, the oil cut meaningfully because it affects exports, according to the Saudis. The Russian export cut was voluntary, wasn't imposed upon them. Manus, we're getting a little bit of clarity here. This isn't a policy meeting, so how much clarity are we going to get?
I think this is an affirmation of just how strong the alliance is between Riyadh and Moscow. And I think when we talk about exports, you've had the line. So Saudi Arabia has extended their unilateral cut. That was pretty much expected. That's the message on the podium this morning. But when we come to these lines of Russia's cut is meaningful because it affects exports, that is where we can measure. That is where we can benchmark. What are they doing, not what are they saying? And when I was here just 3-4 weeks ago standing outside OPEC, His Royal Highness made the point that all we have is trust in what Russia are telling us. But if we look at the export data, that will perhaps underpin the joining of efforts between the Saudi unilateral cut, the Russians coming on board with that. You're looking at about 3% of global output. It's one of those moments, isn't it? They had to empty the bins just when I was about to go on live TV. There's the point. There is the point that the market this morning has had its doubts. Really, in terms of what's going on. Morgan Stanley taking their price down to $70. And I caught up with Halima Croft and Bob and a couple of the other concerned that this unity needs to be reaffirmed to the market.
So that's the Saudi and the Russian story. There's another major player here, the UAE. You caught up with the minister. What did he have to say?
Well, he was on his way out of the Kempinski Hotel, and it was our colleagues on the Prince side. Unfortunately, even I can't be in two places at once, even though I'd very much like to. But what he said was there was a generosity in the move by the Saudis, their 1 million barrel a day extension that they had delivered. Mazrui described it as being generous, and it was enough to balance the market. But as he did say that they were not going to join in on these voluntary cuts. Why? Because the UAE, the last time we were here, got a bump in their quota by 200,000. Some would say at the expense of the African nations. Mazrui said to me on the way out the door from the OPEC headquarters, no, that was not the case. But at the moment, there's still a huge gap between what they're producing and what they've got a capacity to. And that is why they will not join in these voluntary cuts at the moment.
At the moment. Manus Cranny in Vienna. Fantastic as ever. Thank you very much indeed. Let's go from hydrocarbons to global warming. Global temperatures keep breaking records this week, highlighting the extremity of this year's summer in the northern hemisphere. It is extreme and brings into focus the slow pace of growth and what we're seeing in terms of curbing global emissions and the impact that we're already having. Joining us now to discuss is Bloomberg's Will Mathis. Will, how hot is it, and is it going to get hotter?
It's very hot, and yes. So this is the global average temperature. So it's not just, one place that sets a record, but basically everywhere is unusually historically hot. So we've had record temperatures recently in China, in North America, in Europe it's been quite hot, and in North Africa the temperatures have been brutal recently, and even actually in South America, which should be in winter right now. I was looking at the temperatures there and it looks like summer. So it's really the whole world is too hot right now.
So to deal with that trend or that direction of travel, clean energy, of course, really the efforts to kind of adopt them, really accelerating, that can be a very expensive prospect, Will. It can also be met with a lot of supply chain shortages. Walk us through that dynamic.
Yeah, well, it does take a lot of money. I don't know if it would be expensive if you take into account the costs of global warming and of not making those investments. The estimates are in the trillions of inaction. But it will take a lot of spending to invest in mining, in manufacturing, and deployment of all these materials. And it's going to be really difficult to scale up to basically change the global energy system in a few years.
Well, great stuff. Thank you very much indeed. Look at what's going to happen in Germany this weekend. It's going to be super hot. Keep an eye on those Rhine levels, becoming an increasing problem for industrial Germany. Okay, what are we going to do next? Coming up, we're going to catch up with Sonia Martin, DZ Bank Head of Currency and Monetary Policy Research. Looking forward to that. Plus, we're going to bring you Bloomberg's exclusive interview with the Greek Prime Minister Kyriakos Mitsotakis. That conversation coming up.
Before the end of the year to actually repay ahead of time our GLFA facility for the next 2 years. And I think this will also send a positive signal to the markets.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters?
We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policies.
The Fed is going to hang tough.
The June Jobs Report, Friday on Bloomberg Television and Radio.
This is Bloomberg Surveillance, the early edition. I'm Guy Johnson in London. Pretty good is over in New York. Of course, I'm in for Danny Berger. So, Pretty, the Greek Prime Minister, Kyriakos Mitsotakis, has pledged to repay 2 years of bailout loans ahead of schedule. The yield on Greece's 2-year bond falling after his comments. This was an exclusive interview with Francine Lacroix in Athens.
We've been very successful in attracting foreign investment over the past 4 years, but we need to keep up this pace. And this, of course, means various interventions when it comes to the business environment. I'm very preoccupied with justice. We need to make sure that we accelerate justice reform and that the courts don't take for ages in order to reach a final decision. And I'm also particularly concerned about offering Greeks quality health care. We have a public health system, a national health system. It survived the pandemic, but it's about time to make some significant changes to make it more efficient.
Prime Minister, you're very confident that you'll get investment grade. When you get investment grade, what does that mean? What does that change in terms of possible extra investment coming to the country?
I think it changes lots of things. There's currently a lot of capital that cannot invest in Greece simply because we're not investment grade. As you know, we are already trading as if we are an investment grade country. But we also need the official stamp of approval by the rating agencies. I think it will further lower our cost of borrowing, which of course is important in a high interest environment. We've been able to defy the trend. The Greek economy is going to grow significantly in 2023. And this is also giving us a fiscal space to further reduce our debt. We will be able, before the end of the year, to actually repay ahead of time our GLFA facility for the next 2 years. And I think this will also send a positive signal to the markets that not only are we focused on growth, but we also want to make sure that our debt to GDP ratio continues to decline at a very rapid pace.
That was the Greek Prime Minister talking exclusively to our very own Francine Lacroix. His first international interview since the Greek election. The full interview airs July 19th on Leaders with Lacroix. You don't want to miss it. I want to really put some of his comments into a little bit of perspective here. He said it's like we're already trading at investment grade. Well, let's put that into a visual here, because when you look at what Greek debt is trading relative to German bunds, it's actually some of the best performing debt, not just in the continent, but in the world. That 10-year yield spread at about 134 basis points. Guy, to put that into perspective, the Italian spread is about 170. Who would have thought that in this case, Greek bonds are beating out Italian bonds right now.
Yeah, they both still have a significant debt issue that they have to deal with. BTPs obviously represent, to many people, a risk that we are waiting to ultimately materialize. When that happens, I have no idea. But the ECB keeps raising rates, so maybe that's a problem. But I think there is an interesting line that is worth drawing between Italy and Greece. Both of them have significant public sector debt issues. Neither of them have significant private sector debt issues.
Yeah.
And we're seeing mortgage crises in other parts of Europe. These two countries are not having that problem. And the reason is that there isn't a mortgage crisis. There isn't significant private sector debt. Italy, for instance, is a very wealthy country. It's just the balance between public and private sector debt is heavily skewed.
I'm glad you mentioned that kind of dynamic, because one of the concerns around Greek debt is, although they have been doing very well from an economic point of view, a lot of those gains have been coming simply from the tourism sector, whereas the Italian economy, as you point out, does have, for example, a massive manufacturing hold as well. So there is a question about just how much sustainability this kind of Greek winning streak has, for lack of a better term, especially if you are looking at a recession on the horizon.
I will happily go on holiday to both of them. Anytime.
I too volunteer as tribute.
It's worth checking out. Kriti, let's talk about what we've got coming up. A growing chorus of Wall Street warning that the second half is going to be tough for stocks. We're going to talk about that story next. This is Bloomberg.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
This is Bloomberg Surveillance. This is the early edition. I'm Guy Johnson in London, Kriti Gupta, of course, in New York. Kriti, there is a growing list of Wall Street firms that are warning of the risks ahead for stocks in the second half. So you got JP Morgan citing a contracting US economy, Goldman saying the risks of higher rates could weigh on equities, HSBC's in the mix as well, saying there could be a, quote, nasty surprise in store for stocks. The list goes on and on and on. My question is, why am I listening to the buy side? The first half of the year confounded everybody. The Nasdaq 100 posting a record first half, 5 trillion added to the mega caps. It was, of course, the mega caps that kind of drove this story, Kriti. But the buy side, nobody expected the first half that we had, basically, and therefore you've got to look at other factors, positioning, liquidity, all those other things into the mix as well.
Yeah, I'll throw in the fact that history is not on their side. If you look at every single back half that follows such significant gains in the front half, 16%, by the way, in the S&P 500. For the last 20 years, 19 out of those 20 years have been positive for the back half of the year, and not by a small margin. We are talking double-digit gains, Guy. You can see that on our chart for our radio audience. Just take my word for it here, but it's really significant that a lot of ththese Wall Street firms are saying history may not apply this time around.
Yeah, I mean the sell side, of course, not the buy side. I don't know why I said that. There's all kinds of reasons why it might not, but think about it. You're a portfolio manager. You're behind your benchmark. You need to play catch up. You got the tap on the shoulder. You need to push it. Do you continue to buy stocks? Also, there's still plenty of liquidity out there, but if that dries up, maybe that is a reason why the sell side could be right.
And you need a catalyst for that as well, right? And I think that's where the earnings picture really comes in. I want to bring to your attention another call we got from JP Morgan as well. They're writing that the cushion of consumer excess savings is being eroded. Profit margins peaking, money supply in the US and Europe keeps contracting, corporate pricing power likely to weaken from here. And Guy, that is very significant because when you look at it from a fundamental point of view, every single stock on a micro basis has been trading on whether or not you're beating on the margins, and it's far more sensitive to that story than even the top line growth story, which is, are consumers around the world still spending? Well, it doesn't matter as long as these companies are making their margins.
Yep, absolutely. I think this earnings season is going to be interesting. I think the one after that could be even more interesting. But we continue to watch a situation where, in some ways, fundamentals don't matter. And you'd think that the economy would be in worse shape than it is right now, but the market has traded through those fundamentals. Do the fundamentals ultimately catch up with these markets? Sonia Martin, DZ Bank Head of Currency and Monetary Policy Research, is going to join us next. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China services industry growth slowed in June, providing even more evidence that the key driver in the post-COVID recovery is cooling. U.S. markets reopen after the Independence Day holiday. June Fed minutes due out today. It could shed more light on the path of future rate hikes. And oil in retreat. Bloomberg is live in Vienna as traders assess the latest gambit from OPEC Plus to prop up prices by curbing supply. We are all over it. I'm Kriti Gupta in New York with Guy Johnson, stepping in for Danny Berger in London. Guy, the oil story is fascinating to me. We're going to dive into that in just a moment. But I've got to say, it does feel like at the end of the day, it comes down to liquidity, positioning for the back half, and a lot of folks saying this time could be different.
It's always different, isn't it? Those words ring alarm bells. Of course, it's always going to be different this time, but it never is. I don't know what's going to happen in the second half. The first half completely confounded everybody, Kriti. But you take a look at what is happening in the markets today. In some ways, it speaks to the narrative of what we're watching. Data out of Europe today, just slightly weakening a little bit, just incrementally, just softening up a little bit. The PMIs, the final reads. You got China data, which is weak. The Caixin data certainly pointing to a slowing economy there. So diffusion index is a momentum story. That's rippling through European markets. Stock 600 is down by 0.6%. Insurance is down. The miners are down. The basic resources sector is down. I just took a look at the AVAT function on the Bloomberg, Kriti. Volumes like it was super light yesterday. You guys had the day off. Today, it continues to be light, which I think is interesting. The rest of the week, I think, is going to have a lot of action to it. Casino, down by 30%. It looks like shareholders are going to get wiped out. We have 2 competing stories here in terms of how the company is going to be rescued, what capital injection is going to look like. But ultimately, I think shareholders are going to suffer. Is it going to be the French solution or the non-French solution? Euro-dollar, absolutely flat. We've also got Fed minutes coming up. But then we get into some quite exciting data. I'm interested to see jolts. Of course, I'm interested to see on Friday what that payroll number looks like.
Yeah, and I feel like there is that element of just kind of waiting and seeing until we actually get that data, Guy. To your point, yes, we had the day off, but I feel like today is not going to be any different when it comes to a volume or a liquidity perspective. Already you are seeing futures take a little bit of a step back, down about 0.5%. But again, some of that is going to be fundamentally driven. The China data that we got overnight really going to be weighing on that global economic outlook. And you are seeing some of the sentiment from the European session already kind of seep in to what you're seeing in the U.S. The bond market catching a little bit of a bid, though, and this is interesting as we're talking about repricing, a continued story of inflation, yet bonds catching a bid. The 2-year yield, 4.88, that move accelerating, down about 5 basis points. 30 minutes ago, you were only down about 3 basis points. So again, that is perhaps where all the action is going to be in today's trade. When I think bond market, though, you got to talk about the FX read-through. We're going to get an expert on this in just a moment, but overnight, the China action also giving a little bit of a lift to the greenback. Dollar yuan, 7.25, stronger by about 0.4%. Remember, the Chinese are trying to stem the losses in the yuan. If you're talking about contracting economic growth, that's where you're seeing the pain trade. Where you're not seeing the pain trade is in the commodity read-through, which brings us to NYMEX crude, trading at a 71 handle, actually higher by 2%, really diverging from what you're seeing in terms of the global narrative, Guy.
Yeah, it's because you guys had the day off yesterday. Brent is negative on the session. It went up by 2. I'm not
bitter, are we?
Yes, you had many useful things to do, I'm sure. But nevertheless, basically, Brent is down. WTI is playing catch up. I think probably later on you'll see that reflected in what we're seeing in the global crude market. You bring up the minutes, you talk about the data, so let's dig into what we're getting here. Sonia Martin, DZ Bank Head of Currency and Monetary Policy Research, joining us now. Sonia, let's start with the minutes that we're going to get from the Fed a little bit later on. What kind of clarity are we going to be seeing within these minutes? It was a confusing meeting. It was a meeting that confused a lot of people. Are the minutes going to provide us with some sort of insight into what was really going on?
Well, I mean, the interesting thing about that meeting was that the decision to pause was unanimous. That is a clear signal that they were at least in agreement that it was time to, give it a break. I expect the minutes to be quite hawkish nonetheless. I mean, we know that the inflation is still too high. Core inflation is worrying. And of course, we have this incredibly tight labor market. As you mentioned early on, we're going to get some data later in the week. So I expect a fairly hawkish meeting that may reinforce the idea that the Fed will not only have to hike rates again in July at the upcoming meeting, but potentially also into the autumn. So that's what I would expect from tonight's minutes.
Well,
as you say...
Oh, sorry, go ahead, Guy.
Pretty, go. No.
I wanted to follow in on that story. Just how much of the read-through are you seeing from other central banks around the world, or is the Fed kind of beating its own drum here?
I do apologize, by the way, for the construction noise in the building here. I mean, we do have a general issue here with central banks trying to sort of figure out what the good time for the end of the rate hike cycle is at this point in time. It is a very, very difficult time for central banks because they have to balance the need for further tightening in general against the risk of triggering a recession, into 2024. So this is something that a lot of the central banks in the G10 space are currently dealing with, and the Fed isn't the only one. And I think when we look at what happened in Sintra, it was very clear that that is the overriding theme for central banks at the moment.
Well, it's the overriding theme, but at what point and how quickly do they say, look, the slowdown in China is going to have global repercussions, but are the global repercussions the same as they were, say, circa 2008, 2009, especially given that the stimulus this time that the Chinese are trying to pump in their economy isn't having the same effect as it did, say, 15 years ago?
Yeah, I mean, I totally agree with you. I think you did mention earlier on in the show already, I mean, the consequences of the slowdown or slow growth in China may not filter through quite as quickly or as severely as they have done in the past. But we don't have only China. We have fairly weak growth in Europe. We have the potential still for a slowdown recession in the US, although that is probably the most anticipated, predicted recession in the U.S. history. So we have some weakness coming through. But the problem is that, it's going to be very difficult to gauge, at what point it's really going to start hitting.
The potential for central banks to overdo it at the moment is significant. The Bank of England looks like a perfect case in point, Sonia. Is the Bank of England going to have to break the UK economy? And is, in the process, the pound going to benefit? But is the long-term picture actually that positive? I keep reading positive notes about the pound, and I'm slightly scratching my head.
I totally agree with you. I think there's absolutely no cause for any sort of enthusiasm here. And in fact, I would say that the rally that we have seen this year, which, saw the currency benefit pretty much across the board. And, it's the best performing currency in the G10 space during the first half of the year. That was already overdone. I think it came from the realization that the economy wasn't doing as poorly as people had expected. But that doesn't mean it's performing well. And as you said, the Bank of England is now at a real risk of overdoing it. The market is pricing in a term rate of 6%, even higher. If the Bank of England were to go that far, I think a recession in 2024 would be inevitable. So I think we've reached the point where further tightening is going to be currency negative.
So how far do you think they're going to have to go?
5.25 is probably going to be the end of the line. 6% seems way overdone. They've already done a lot of tightening. And also you have to ask the question of tightening further right now. I mean, how much is that going to benefit in terms of reducing inflation? There's a considerable time lag, 6 to 12 months. So tightening more now doesn't necessarily mean that inflation now is going to go down. So that at some point you have to wait and let things play out because they've already done quite a lot and then see how that plays out.
Sonia, I want to harp in on what you just said there. Further tightening could be currency negative. I think that's a point that a lot of people have kind of been waiting for that pivot to take place. Essentially, the interest rate differential is no longer driving the currency to the upside. So, Sonia, what is a positive for the currency, whether it's the pound, the euro, or arguably even the dollar?
I think at this point, it's really about the fundamental outlook, because there's so much concern in the market that central banks may be tightening the screws too tightly and thereby risking, a significant slowdown. So I think we're going to switch, away a little bit from the monetary policy focus as we move through to the autumn, back to sort of very basic fundamentals. I mean, look at the Eurozone market has been, downscaling its expectations. That's way on the Euro, whereas in the US, we've seen a lot of upside surprises. Yeah. So I think that's where the direction is going to come from, in the autumn and winter.
How are you factoring in the fiscal response, for example, the Biden administration talking about student loan forgiveness, and in Europe, perhaps talking about energy subsidies, especially as we go into the winter? How is that factoring into your FX models?
Well, I think it's a topic that is particularly relevant, I think, at the moment, obviously, when we look at China, because people are expecting there to be some supportive action from the government and the central bank to alleviate or to improve the economic performance. In the US, I think right now it's not so much in focus. It will obviously, it plays a role. Whereas in Europe, it always is a bit of a two-edged sword, isn't it? I mean, we look at fiscal policy as something that can be positive, but obviously we also have a huge debt burden that we have to deal with, and then very quickly we end up discussing potential problems in various countries.
Sonia, what's your big trade for the second half, and what's your degree of certainty around it? Because the first half caught so many people by surprise.
It did, yes. I mean, we're still looking for stronger euro-dollar trade, but you asked me about certainty, and I would say at this point, with the U.S. still holding up much better than anyone had expected, my degree of certainty on on that call is definitely lessened. I think the really big, interesting currency we have to look at is still dollar yen. I mean, I know people have been frustrated, that the central bank hasn't changed its policy, but this is an all or nothing decision. You either change the policy or you don't, but you don't talk about it before. So the fact that they haven't mentioned it doesn't mean it's not going to happen. I think that's going to take a lot of people by surprise. So we still see dollar yen significantly lower.
Love that you mentioned the dollar yen story. I think the hedging story that comes with it as a function of that weakness is so fascinating. DZ Bank's Sonia Martin, thank you as always for your time and your insight. Coming up on the show, European banks failing to recover after the fallout from the banking turmoil in March. We're going to get the outlook from Bloomberg Intelligence. That conversation coming up next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become
the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. After withstanding deposit flight risk that began in the United States and fears of an economic slowdown, European banks had a first half filled with ups and downs, and their uncertainty looking to remain as we start the second half with interest rates near their peak and revenue back in focus. Joining us now is Philip Richards, Senior Banks Analyst from Bloomberg Intelligence. Philip, European bank shares failed to return to levels before the U.S. regional banking crisis. How much of that is a result of liquidity and deposit flight? Put that into some perspective for us.
Yeah, good morning. Actually, we don't think it is about liquidity. Actually, in the first quarter results of the banks, the deposits have held up very well. We expect that to be the same in the second quarter results in a couple of weeks' time. Now, what it is more about the earnings outlook for the banks, and that's been a big concern, which seems odd because obviously interest rates have been increased so much over the last few months, and the earnings have risen. But now the risk is we're at the turn of that earnings cycle. And actually, the amount of rate hikes still to go is very limited. But actually, more importantly, is the banks are going to have to start passing on a lot more of those rate hikes to depositors. And that's going to actually squeeze their margins and actually could push revenues down from what's been expected.
Given where we are with valuations, though, on European banks, isn't a lot of that already priced?
It is priced in, but there is a lot of uncertainty too. I mean, we know we're going into an economic slowdown, but is it going to be severe? Is it going to be gradual? We don't really know. Also, credit quality, has held up very well so far. But if you stepped into where we are today, we thought interest rates are high, uncertain economic outlook, then why are bad debts as low as they are? The risk is actually that kicks up and that just starts rising. And that's where investors are quite concerned.
Philip, Guy made a really important point earlier in the show. We were talking about the success of German debt, Greek debt earlier in the show. And he said, look, the public debt is still the issue, but the private debt you're seeing in Greece and the likes of Italy, not so much, which is, I think, contrary to what a lot of people would expect, especially on this side of the Atlantic. We're also getting a headline here from the Italian finance minister saying Italian banks are in a better position than they have been in the past. Philip, can we write off the risks that we traditionally associate with the periphery at the moment?
No, I don't think you can. I think those risks are very much still there, and I think that is reflecting in those share prices. As you say, the debt levels are very high across Europe, and a lot of the mortgages that bank people have are on fixed rate mortgages. So if you're tied onto that, you haven't had that impact yet of those interest rate hikes. So as those mortgages gradually roll off, actually maybe some of that pain, some of that squeeze is actually still to come. Now, certainly the fears are for the UK.
So
that's certainly true for the UK, but let's, sorry, Karima, just jump in. But what about, so the relationship between Italian banks and the bond market, the govie bond market, is probably the most significant relationship there. They don't have the mortgage risk in the way that that we see in, say, Sweden, but they do have the potential doom loop that still exists if we were to see BTPs blowing up. Is that, how significant an overlay is that onto Italian banks, some other banks around the periphery of Europe?
Well, the risk is there, but if you look at the valuations, the banks know we're flagging today in terms of the 0.3, 0.4 times valuations. It's your SocGen, it's Barclays, it's mainly the big investment bank. It's not actually the peripheral banks, as they were called in terms of the Italians or the Spanish with the sovereign debt. So actually, they're actually trading at much better levels, which shows that there is less concern on that front. Which
in terms of
how high interest rates obviously are.
Yeah. Talk to me about CRE risk.
Well, CRE risk is a funny one for us in the banking sector. We're hearing all the concerns and the worries people have in CRE, but at the same time, the banks have had, been expecting this to a degree. They have diversified their portfolios. They've got very strong covenants. Their average loan to value on their lending is average about 50% or so on average. So yes, you might hear stories of CRE risk, prices falling 20, 30, 40%. But that doesn't really impact the banks, given those very low cost-income ratios. But of course, if the pain continues and continues, and you start getting companies collapsing, then it obviously will kick into the bank. So bottom line is we're not there yet, but that risk is absolutely there.
Talk to us about how you're valuing some of these stocks, though. What is your mechanism here? We talked about kind of deposit flight. We talked about interest rate risk. I mean, is it as simple as looking to kind of the price to book ratio? It feels like that seems to be the easy go-to trade stateside. Does that still apply for a lot of these European banks where that ratio has significantly dropped?
Yeah, it does. But obviously, you've got to compare that to the return on equity, which the banks are generating. Because if banks with a higher return on equity expect to trade at those higher levels, so that's when you compare, say, the US to the European banks. Now, the US banks are trading on much higher multiples, but they're also generating much better returns. And if you look at the European banks, they have returns have improved. They are now 7 or 8%. But even against those levels, those 0.3, 0.4 valuations do seem very low. And if you're looking on a 10, 15-year view, those 0.3, 0.4 are really the lowest they've ever gotten to.
Perhaps a positive for investors who are bullish and a negative for those who are perhaps already invested. Philip Richards of Bloomberg Intelligence. Exactly, walking us through some of the dynamics in the European banking sector. We thank you as always. Coming up on the show, I'll look at some of the market-moving events to watch throughout the day. We'll walk you through it. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance, the early edition. I'm Guy Johnson in London. Kriti Gupta, of course, back in New York. Kriti, let's talk about what we got for the rest of the day. Lots of central bank kind of elements being folded in. We're going to hear from the ECB's Villeroy, 7 a.m. Eastern time. Where will he be in terms of this debate about overdoing it, which is kind of getting a little more traction here in Europe? Then we get US factory and durable goods orders at 10 a.m. I'll break that a little bit later. FOMC minutes are due at 2 p.m. We're going to get remarks a little bit later as well from the very important New York Fed President, John Williams. John's going to be speaking at around 4 p.m. Kriti, I am certainly looking for a little bit of clarity coming out of those Fed minutes as to that hawkish hold we got from the Fed. It was unanimous, that decision. I just want a little bit of color, a little bit of context around that decision.
Yes, just how much kind of leaning towards having that more hawkish tilt, especially after the comments that we got in Sintra, Guy. I think that's really important as well. I'm also curious about those 4 p.m. comments from John Williams, because even though they're not happening during the trading day, I wonder how much they're going to influence the pre-market trade tomorrow, specifically when it comes to liquidity and the Treasury story. Of course, a lot of that coming out of the New York Fed anyway.
What I'd really like to know is where he stands on the Dudley comments. Bill Dudley talking about the fact that he sees the 10-year going to 4.5. Morgan Stanley leaning against that story. They think the rate's going exactly the opposite direction. John's not going to give us a take on that, but I'd be interested kind of which side of the fence he's kind of leaning towards.
Yeah, and how that's interpreted by the market. Again, perhaps a lot of the critics would say that the market tends to overreact, which brings us naturally to the stock market and what they're doing in the pre-market. Guy, we got to take a quick look at some of these EV stocks, especially the heavyweight Tesla. We know has been driving a lot of the gains year to date. Well, look, the Chinese momentum has really given it a little bit of a tailwind lately, perhaps taking a little bit of a breather today. Tesla shares down about 1%. You are also seeing Rivian higher by 3.3%. We know they had those record deliveries coming out on Monday. It looks like a little bit of that momentum still coming in, given your point from earlier, which is simply that on Monday there was very light trading. So the U.S. trading session already playing a little bit of catch up this morning.
Well, I think there was a pop, but there also was a fairly big pop in these stocks. The Tesla delivery numbers were outstanding and much better than anticipated. They are sacrificing volume for margin at the moment, but it's working. The Rivian numbers, Ed Ludlow breaking those, absolutely sensational. She had a big pop, so it's not a big surprise for me to see some of those stocks just softening up a little bit after such a big move.
Yeah, and a lot of that growth, by the way, coming out from China, specifically the leader in electrification already. So if you look at the exposure and the partnerships being made there, that's going to be significant, especially as Rivian is starting to ship some of the Amazon vans that they're partnering with to Europe as well. So they're really taking kind of that international take as opposed to specifically the United States. But I think the U.S. consumer story is also important, which brings us to our next few stocks that are moving this morning. Carnival Cruise Lines, Norwegian Cruise Lines. Now look, to me, I love looking at the cruise lines because they are essentially vehicles for volatility. We don't just look at them for kind of this idea of, are the cruise lines profitable? We look at them as kind of a proxy for that U.S. disposable income. And that's why I think as you start to see a lot of the macro analysts be proven wrong about the resilience of the economy, some of these cruise lines were the top 3 performing stocks in the second quarter. Carnival, for example, up 86%. Norwegian, up 62%. That, to me, feels more like a volatility trade.
Well, they've been huge performers. They've been the beneficiary of the reopening trade, and that trade has gone on a lot longer. You take a look at the airlines as well. They continue to be super positive. They continue to be super positive through the summer. My question is what happens after the summer? I was reading a lot of reports over the weekend talking about the fact that the U.S. consumer is now basically running out of money. That the stimulus check story is now over, and it'll be interesting to see how much sustainability, therefore, there is in this consumer trend.
Yeah, there is going to be a little bit of catch-up. And I have to say, when it comes to that consumer trend, remember, volatility goes in both directions. So even though you see these massive gains, it can very quickly kind of collapse on you as well, guys. So I think those are going to be the stocks that we're watching this morning, at least in terms of light volume trading. The VIX especially is going to have a big correlation with those cruise lines. But I got to say, I think it's still the macro trade for today.
Oh, the Fed minutes a little bit later on. Going to be fascinating. Big end to the week. Payrolls are going to be massive too.
Yeah, we're going to be monitoring those into the close. Well, that's it for early edition surveillance is ahead. I hear a rumor that John Farrow is back in town. He and Tom Keene are going to take you through the morning trade. Stick with us. This is Bloomberg.